Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures are trading in the green after December PCE data showed the Fed's preferred inflation gauge came in line with estimates, rising 2.8% year over year. The muted data for December gave a positive sign in the Fed's fight against inflation.
Plus, Apple pushing higher this morning after the iPhone maker gave a reassuring revenue forecast. But the results, though, still renewing some concerns about one of Apple's largest markets, that's China. Revenue there plunging 11%. Meanwhile, shares of Intel gaining after quarterly revenue beat expectations, though the chipmaker did warn that its push to become more competitive is still a work in progress.
And President Trump set to impose his first wave of tariffs when the clock strikes 12 tonight. The president planning to impose 25% tariffs on $900 billion in goods from Canada and Mexico, the first wave of levies since taking office. Commodities markets are pricing in elevated odds that the Canadian levies will cover raw materials including crude, copper, and aluminum, according to Goldman Sachs. U.S. stock futures edging higher this morning after the latest batch of inflation data showed the Fed's preferred inflation gauge came in line with estimates. You're taking a look at the futures here right now with inside of 30 minutes until the start of today's trading activity, higher by about 0.25% for the Dow, S&P 500 futures up by about 0.4%. In the Nasdaq futures up by about 0.7% in what has been a whipsaw week. We started off with some volatility, a lot of volatility driven by DeepSeek, and now hopefully ending with some calm, some cooler heads prevailing.
Yeah, certainly. I think the big test here is what exactly the next few days are going to look like here. Obviously, when you got this reading here on inflation, a bit reassuring, the fact that it did come in directly in line with analyst expectations, not necessarily showing the progress that many have been hoping to see, and the Fed has long talked about and long waited for that further progress there in terms of getting back to that 2%, but certainly nothing in this report, it doesn't seem like, at least derailing the narrative that we have heard from the Fed, that we have heard from policymakers here over the last several weeks. And I think this is very important, especially ahead of this weekend, when we talk about the threat of tariffs and what exactly could be implemented here tomorrow, February 1st. That is the other focus here for investors. President Trump set to impose 25% tariffs on $900 billion worth of goods from Canada and Mexico, the two largest buyers of U.S. goods. We also know that he has threatened tariffs on Chinese imports as well. But let's start with Mexico and Canada. The 25% tariff threat, very much a debate out there in the street when it comes to policymakers, when it comes to political analysts, political experts, and even those within those economists out there, just in terms of how likely it is that we do see a follow-through from the administration, whether or not it's going to be used more as a negotiating tactic. Very much a similar argument and sentiment also being viewed here with China. We have seen President Trump back down or back off his rhetoric just a bit here. Clearly, no tariff was imposed on day one, a promise of his campaign. So that, at least, the market very much has been reading the tariff story right now as very much through rose-colored glasses, I think, just in terms of the more optimistic view that they have taken. This weekend could, of course, change that.
Yeah, no tariff imposed on day one, but you saw the framework set up for it. As we saw the America First trade policy, that was signed on January 20th, 2025. So the first day that the president reassumed office and Trump reassuming office, the Office of the U.S. Trade Representative announcing that it was going to review some of the foreign trade practices to account for practices which they deemed might be unfair to the United States. And the way that they're labeling these tariffs as well as punitive specifically strikes me, especially given that they were talking about how these practices might be unreasonable or discriminatory and how that may burden or restrict the United States commerce here. Now, the larger question is what each of these entities from Canada, Mexico, and China, what they will come back with in their terms of tariffs as well, and what we could see in a kind of tit-for-tat play out, because that's exactly what was one of the larger implications for the markets to have to consider during Trump 1.0 years ago.
All right, let's get to Apple. Apple topping first quarter estimates of strong sales of MacBooks and iPads overshadow weaker than expected iPhone sales. Still, Apple CEO Tim Cook calling it the company's, quote, best quarter ever. Joining us now, we have Gil Loria, his D.A. Davidson's managing director. Gil, you actually raised your price target on the stock, raising it to $290. That's up from $260. Let's talk about how the street is interpreting this, because very much the guidance seems to be enough to soothe some of the nerves out there. How are you looking at the results and ultimately what this signals here for Apple this year?
Yeah, so for Apple, what's really important is, are we going to have an iPhone upgrade cycle? And we got some good news in that regard. Overall, iPhone sales were down, but that was really because of the big drag from China. We could talk about that. But importantly, Apple is seeing early signs that Apple Intelligence is driving better sales. And we've only just started introducing Apple Intelligence functionality into the iPhone. The more functionality comes in, the better it is, the more integrated it is into our experience, the more people are going to encourage each other to upgrade their iPhone, which is the key to Apple. More iPhone sales, more wearable sales, more service sales. That's how we're going to get acceleration of revenue growth in Apple. And we got enough of that in the quarter that investors are more optimistic.
Do you think going forward here, especially for some of the core regions that Apple wants to lean further into, that they need to do something on the pricing front in order to make sure that they're actually bringing people on, especially in these early waves of not just the new iPhone features, but the operating system changes that they're making with a mindset for artificial intelligence?
Yeah, that's a very important point. The pricing strategy here has to be region by region. For instance, in China, they had promotions on iPhone. That's something we in the US would never see. You'd never walk into an Apple store and see a discount on iPhone. In China, they just did that. They cleared the inventory. That's why sales in China were down. By the way, that sets them up better for the rest of the year, even in China. In other regions, there's still a need for them to find a lower end strategy. Overall, they want to increase the average selling price, and that works in a lot of markets, but there are some markets where they need to start figuring out what the lowest price iPhone is to maximize their ability to penetrate these newer markets.
Gil, I'm curious your read on how the market has been reading Apple right now in relation to AI, because it actually got a pop this week from when many of its big tech peers were under pressure on the heels of the DeepSeek headlines that we got out here over the last week or so. What should Apple's AI initiatives look like? And now the involvement here of DeepSeek, what does that spell out for Apple?
So the reaction to Apple was spot on, right? Because the developments around AI getting orders of magnitude more efficient is exactly what Apple was playing for. Remember, Apple isn't building massive data centers like the other mega caps in order to build bigger and bigger models, which is now looking a little wasteful after we saw what is possible in AI. Apple was always focused on, we're going to wait for the models to get small enough that they can go on the handset in the Mac, and then we're going to be able to execute on an AI strategy that way without throwing tens or hundreds of billions of dollars into massive data centers. And they're being validated for that strategy because the models are now getting so small and so good that eventually most, if not all, of the AI we use will be on the handset, which is going to be far more efficient for them, especially since they have our information, they have our context, they have our calendar, they have our correspondence. So they're going to be able to deliver the AI to consumer, and they're really in the best position to do that.
Gil, we're looking at shares of Apple here pre-market. Looks like they're set to pop at the open by about 4%, but even with that 4% rise, they're really just going to be making up what they had essentially lost since the end of December here. So all these things considered, what is an investor to do with this name after an earnings report like this, with some of the perhaps larger themes that are at play with Apple?
We think that Apple is in a good position because short-term expectations are reasonable and long-term expectations is where we're focused on. Again, if we have an upgrade cycle in iPhone over the next couple of years, that's when Apple's stock outperforms. And yet nobody's expecting that to happen next quarter. And so Apple is set up well. It's trading at a higher multiple, but that always works when you have accelerating growth, which appears to be the case for Apple. Now, the excitement that we had at peak, the peak of the stock was when people were using the term super cycle. This was never a super cycle. It's an upgrade cycle. It's playing out gradually. And as it plays out, revenue is going to accelerate. The stock can outperform.
Gil, while we have you real quick, just going back to the comments that you made a moment ago in regards to China, and they're actually relatively upbeat just in terms of maybe what this signals here going forward. I want to pull up a chart, and this very much shows Apple's revenue coming from China, and obviously has been on a steady decline here. You can see that at the right-hand side of your screen. What does that then look like? In terms of reaching a bottom, how should investors then be thinking about that?
China will continue to be Apple's toughest market, and gradually it'll become less and less of the business. I mean, it's already gone from being 20% of the business, about 15% of the business. It's more competitive. There's political pressure on Chinese to sell less iPhones and sell more of the domestic brands. The domestic brands are finely tuned to the local market. They're very powerful competitors, more powerful than Apple encounters anywhere else, really. So it'll continue to be a tough market. It'll continue to be a volatile market. But over time, it becomes a less and less important part of the story. And importantly, right now, after a quarter of clearing inventory from China, they're set up for it not to be as much of an issue for the balance of the year.
All right, Gil, thanks so much. We're going to be watching shares of Apple closely here at the open. Appreciate it.
Thank you.
Let's take a look at Intel, beating fourth quarter expectations even as revenue declined for a third straight quarter. The chip maker also issuing weak guidance for the first quarter, citing here seasonal weakness, macro uncertainty, and competition. This is Intel's first report since CEO Pat Gelsinger was ousted last month. The company appointed 2 interim co-CEOs as the search for a new leader continues. Shares right now of Intel, they are up here pre-market here, and I think with the incoming administration as well for Intel, they also have to continue to acknowledge how much of the money that they're expecting to continue to be dispersed for some of the efforts that have already initiated in chip fabrication and the factories that they've touted and even started to break ground on as well.
Yeah, it's a little amazing to me that that Intel's actually trading in the green right now, up just about 1.5% ahead of the open, given the fact that the guidance was light. And I bring that up just in light of the reaction that we have seen to so many of the names that have already reported this earnings season. If you're not beating by a pretty sizable margin, you're not necessarily seeing that the reward pay off the next day, especially when it comes to guidance. We talk so much about the focus here on guidance. So the fact that we are moving to the upside, I think also just shows how skeptical the street was heading into this report, just in terms of any progress that Intel has made on this front. In regards to that guide, though, there's a couple of things that analysts were pointing out this morning that I thought was interesting. JP Morgan, one of the analysts out, saying that they're blaming a lot of it on macro uncertainty, obviously PC inventory digestion, but also rising competition. Is that last component there, rising competition, that's going to be the huge hurdle here for Intel going forward. We talk a lot about the turnaround plan, the fact that it's going to take time to play out. And we're not talking a couple quarters. A lot of the experts that we've had on here over the last several quarters have very much chimed in and say that this is a multi-year potentially turnaround story here, and it's going to be something that's going to take years and years. And I remember the day after Gelsinger was stepping down, we were talking to one analyst, and he was saying that, hey, this could actually take up to 10 years. And I think that very much puts it into focus, just the disadvantage that Intel is at right now in regards to some of their peers, and how much it has to do in terms of catching up.
Yeah, and it really comes back to how much money they're going to be spending in that longer term period, in that time horizon that you were mentioning of 10 years. I think back to what was mentioned on the earnings call here. They're anticipating 2025 gross capital investments will be approximately $20 billion. That's at the low end of their previous guide of $20 billion to $23 billion, and that's reflecting further capacity adjustments in some of their production and staffing as well in Ohio and Ireland, better utilization of what they call their construction in progress as well. So you think about the investing and how that is ultimately going to have to pay off before investors and until investors have clear line of sight into where that will actually flow through to margins and then flow through to share price appreciation as well, to your point.
All right, we'll keep it right here. We're just getting started on Morning Brief. Coming up, we're going to count you down to the opening bell on Wall Street. Plus, we'll break down big oil earnings with the results from Chevron and Exxon. Now look at AbbVie as the drug maker offers an upbeat forecast. You're looking at gains of nearly 5%. We'll discuss that and much more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we've got some earnings, from several oil companies out this morning here. You see what I did there? Merged them two together. Anyway, ExxonMobil, they beat street estimates on the top and bottom lines, driven by higher oil and gas production. Meanwhile, Chevron reported the first loss in its refining business since, get this, 2020, and weak jet fuel demand in the U.S. And then Phillips 66 had a smaller than expected loss in the quarter as its renewables income notched a profit. Here to help break it all down and really set the scene, we've got Fernando Valle, who is the Hedgeye energy strategy analyst here. Fernando, great to have you here with us. All right, just want to get your common denominator, if you will, through all of these earnings, if there is one that you're able to pull out.
Hey, absolutely, and thanks for having me. I think the big one is really around free cash flow and the ability to sustain payouts. And that's why you're seeing Exxon outperform here, while the other two are doing worse off. It's really around their ability to generate free cash flow, their ability to sustain their not just their dividend in the case of the oil majors, but also their buybacks. They had very aggressive buybacks. And if you look at Chevron, they outspent by nearly $6 billion on that buyback. And whereas with Exxon, there's a much smaller outspend, while both companies have significant growth coming online in the first quarter of the year. So that should narrow significantly. But still, it's really around that sustainability of the payoff.
Fernando, talk to me a little bit more about, and Darren Woods was commenting on this, just in terms of the higher margins that Exxon specifically is seeing when you take a look at the Guyana projects, when you take a look at the Permian Basin, just to what extent does that ensure profitability when we talk about the uncertainty surrounding how this energy transition is going to play out? What position does that then put Exxon in?
Well, we have Exxon as our best idea along as far as the oil majors go, because we think they have the best go-forward portfolio of any of the 5 big oil majors that include Chevron, Shell, BP, and Total Energies. The reason for that is really Darren and the turnaround he's conducted since he's taken over as CEO. You mentioned the Guyana project. We think that's the best growth project in the world right now. The Permian, after Pioneer, Exxon has the largest and best Permian of all players in the U.S. Well, overall in the Permian. So I agree. I think that's why we like Exxon. We think they're going to be a serial compounder from here because they have room to grow. When we look at Chevron, its main peer and benchmark, we think Chevron has an issue with their go-forward portfolio. Yes, they have a good Permian, but that's pretty much all that they have. They didn't do enough to acquire low-cost assets like the Guyana asset or some of the LNG projects that Exxon is developing in order to continue to grow. So a lot of the story on Chevron is going to hinge on their ability to complete the Hess acquisition, which they've now slated for the third quarter of this year.
Fernando, President Trump did not rule out the possibility of tariffs on oil from Canada and Mexico. Speaking from the White House yesterday, I want to play this quick clip and get your response.
We're going to make that determination probably tonight on oil, because they send us oil. We'll see. It depends on what the price is. If the oil is properly priced, if they treat us properly, which they don't, we have all the oil you need.
To what extent do you believe that investors and analysts are already starting to price this reality into some of the names, Exxon and Phillips 66, as well as Chevron?
I think it's just starting to hit because we actually don't have all the oil we need. We need Canadian oil. I mean, yes, Canada is in a bit of a liable position to us because we take most of their exports. But what the U.S. produces is a very light oil that is not conducive to produce diesel, for example. So we need the Canadian heavy crude in order to balance it in our refineries. And I think that's partially being reflected in Phillips today. It might be reflected on Valero as well, that if these tariffs come on, it might be very detrimental to them. Exxon is in a unique position because they own 70% of Imperial Oil in Canada, but then they are also obviously are a US-based company. So we feel it on both sides of the equation. But ultimately, Canada has no other option but to export through us. Yes, they built the Trans Mountain Pipeline, but even that needs to typically be imported into the US in order to make it out to Asia. And then most of it still goes through the Keystone or Enbridge pipeline systems down to the Gulf Coast if it's to be used in our refineries or if it is to be re-exported from there.
So, Fernando, I guess for investors, even for consumers or community who's trying to game this out, what's the ultimate impact then on prices?
I think ultimately there's no way that we're going to have long-term tariffs on oil because it would mean much higher inflation for U.S. consumers. So I think this is a game of chicken. I would fade it in the long term. I think we need Canadian crude, especially if we're going to enforce sanctions on Venezuela and on Iran. We're going to need Canadian crude. This is a bit of gamesmanship by President Trump, in my opinion. I would fade any of the impacts for it right now because, again, if we're trying to control inflation, we're going to need Canadian crude.
All right, Fernando, great to get your insight. Thanks so much for joining us.
My pleasure.
We're taking a look at another trending ticker this morning, and that's Walgreens. Shares falling double digits in pre-market. You can see it off just about 12%, just above $10 a share right now. This comes after suspending its quarterly dividend, doing it for the first time since 1933 as part of its company turnaround plan. Now, in a statement, Walgreens saying, quote, the company's cash needs over the next several years, including with respect to litigation and debt refinancing, were important considerations as part of the decision to suspend the dividend. Again, you're seeing shares under a bit of pressure on the heels of this. Clearly, Walgreens is doing this in a move to conserve cash or trying to strengthen their balance sheet. It's certainly been a tough road, to say the least, for the company. You're looking at today's move. If we could take a look at a longer-term chart, very much showing, better describing the pressure that Walgreens has been under here. That's 5 days. If you were to go back several months, 6 months, you're still looking at some pressure in the stock. If you go back over the last year as well. So again, the question is what Walgreens needs to do in order to better turn around its business. Evercore weighing in, say that this is actually making some progress. They have made some progress on plans to put the company in a better financial shape over the next few years. But you can see after a decline of nearly 50% over the last year, more changes are likely necessary in order to regain some of that lost momentum.
Yeah, everyone will remember to kick off the year, essentially, this was one of the first earnings reports that we had gotten from Walgreens Boots Alliance, and the first quarter loss per share was 31 cents versus the 8-cent year ago quarter here. So loss per share worsening a little bit more, adjusted EPS 51 cents versus the 66 cents a year ago. But ultimately here, within the guidance, they did maintain some of that guidance, but I think for investors, they're waiting to see, especially with some of the contributions that the company has been talking about with regard to the sale leaseback plans, trying to offset some of the declines in the U.S. retail pharmacy segment as well. There certainly is a longer climb here to fully turn the business around here, especially with the consumer machinations that have been playing out here as there are less consumers that contribute to the foot traffic going into some of these same Walgreens because there's not the same push for getting vaccinated or making sure that you've got a regular pharmacy check-in if you can just get those things delivered at this point. So all of those kind of combine to create a conundrum for Walgreens in the near term, and much of the investment community waiting for how that plays out.
Yeah, certainly. I think the reimbursement aspect of it clearly a headwind here for the company, increased competition from online retailers. And then, of course, reports and interest there potentially going private when you talk about the interest there of Sycamore Partners. So very much there is uncertainty surrounding this name and what that road ahead looks like.
Finally here, let's talk about shares of Decker. They are falling this morning after the company's guidance missed analyst estimates. The maker of UGG, comfy, and Hoka, comfy, expecting to do $4.9 billion in sales in the current quarter. That's just shy of the $4.3 billion estimated. Now, despite that, Decker reported strong holiday sales for its Hoka brand, with net sales rising 24%. You're taking a look at shares right now, down over 12%. The company is saying that during the most recent quarter, they had exceptional results, record quarterly revenue, gross margin, and earnings here, that coming from the president and CEO, Stefano Carotti. And then they also invested more into the experience as well. Hoka saw some impressive results. They say, of course, the chunky running shoe, as many people know it. And then UGG, of course, the comfortable, ugly boot, I guess. But
hey, I'm a big fan of both.
Yeah.
I'm a buyer of both.
Yeah.
And I think you can tell the turnaround here in UGG's business. It accounts for more than 50% of the company's revenue. You talk about the rising of Hoka and the rising popularity of Hoka, the outperformance that we've seen in some of that brand here over the last several quarters. But again, when you take a look at some of the strength that we did see in this report, although investors very much discounting much of that, is from the UGG's brand. And I think going forward, Hoka, some of those gains are expected to slow just a bit. And when you talk about the fact that they had seen such fast expansion there, lots of questions from wholesale partners, what demand is going to look like, that's putting a little bit of a lid here on any move to the upside. So again, we're looking at shares under a bit of pressure today. But I do think the UGG business, given the holiday outperformance too, is a sign that there is a silver lining in this report.
is that a practical New York shoe, New York boot?
Hell yeah.
Yeah? Hell yeah, Shauna says.
It is.
I mean, it's got to take on a lot of wear in New
Yes.
York. All right.
It's the best way to commute.
All right, emphatic buy
Don't knock
signal
it
from
until you
Shauna.
try it. Have you tried UGG boots yet?
No. I got to try some at home first before I go out in public.
All right, just give it time, because if you try it, you'll love it. All right, coming up, we've got the opening bell next.
9:30 a.m. Eastern Time. You know what time it is. It's time for that opening bell. You've got a live look at the NYSE. Great bell ringers over there. And you got a live look at the Nasdaq. Some great bell ringers over there too here on this Friday. Let's take a look at how the markets open up here on today's activity. We're seeing out of the gates right now, fractional move higher for the Dow Jones Industrial Average. That's exactly where the futures were pointing. That's just what we got. The Nasdaq Composite, as you're seeing that open up as well. Fractional gains. S&P 500, fractional gains, about 0.5% right there. Let's dig a little bit deeper into what's transpiring early on in today's tape with some sector activity. Taking a look at XLK, technology is leading the pack. Staples pulling up the caboose here. We're looking about as flat as you can get, or at least about a split, I should say, as you can get for 11 S&P 500 sectors here. But looks like we do have more in the red than in the green as of right now. Let's also take a look at the Nasdaq 100 since we mentioned tech and the outperformance, at least in today's session. Early moments here as we are. Apple company just reported earnings. They're up by about 3.6%. And here's what we're talking about. Let me just go back into that chart. We were discussing this with Gil Luria a moment ago, and I'll give you a year-to-date view of what's been transpiring with today's move. Potentially, if we see back towards some of the pre-market environment and ballpark that we were in, Apple could potentially get back into positive territory for the year, but we still do have a little bit of ground to make up there. Again, we were seeing that in futures, but we'll see exactly what the rest of today's session holds. Also checking in on some of our friends here. Microsoft and Nvidia split right now. Microsoft higher by about 1%. Nvidia down by about flat, but just barely into the red. And just as I'm talking about it, flips into the green. Shows me. And Amazon, that starts off the day in positive territory. That's up by about 1.5%. We'll ride out with a quick look at the Dow 30 components here. I'll put that on equal just so you can get a good heat map view. And it looks like we're almost split, but more it seems to the downside here with Chevron, one of the companies that just reported earnings, pulling up the caboose. That's down by about 2%. For a little bit more of a deeper dive into today's early action, let's get on over to Yahoo Finance's Jared Blickery for a look at what is moving. Hey, Jared.
Why, thank you, Brad. We are wrapping the month of January, and I've got some interesting stats for everybody in the 10 a.m. hour, but we are looking at the best month for the S&P 500, the Nasdaq and the Dow, and the Russell 2000 since November. November was a pretty big month there, so hard to beat. Just showing you the year to date, and that's also going to be the month to date. So looking at gains, 3.69%. And this has predictive power for the rest of the year, which I will get into in about 45 minutes. But for now, I want to check in on the dollar, which has been moving higher for the last 4 days, but not much of a big rally there. Not too concerning with respect to the risk markets. And Wednesday, we didn't even see that big of a reaction off of the FOMC announcement. I want to get back to the sector action because I was looking at the leaders today. So XLK and XLC, that's tech and communication services, leading here, kind of switching places, number one, number two. Tech was lagging yesterday, so that's a reversal of fortune. And I want to dial up XLC here because it is probably, yes, it is heading now for its first record close of the year, also up 10 straight days if it holds these gains into the close. And that is driven by Meta. And let's take a look at Meta here. Lots of focus on Apple was having its best day since June. Not sure about that right now, but here's Meta, which has been rocketing higher to record highs day after day. That is up 10 days, and that's what's been driving to a large degree that XLC move that we've been talking about, at least that I've been talking about. Also want to talk about Alphabet here. Here's Google, Googl. This is opening up near a record high, and I think that's probably going to be good enough for a record high. Yes, it is. And we'll switch back to a line chart right there. And then sticking with tech, I want to get to IBM. IBM just came off its best day since 1999. It was its third best day since 1968, and that's according to Bespoke Investment Group. You can see here it is rocketed past these record highs, and just interesting to see that this is a legacy tech play which has just really come to life over the last few years. Here's a 25-year chart, and this is actually formed a nice cup-in handle here that is broken out of. And if we take a max chart, and I did mention 1968, and we can actually get data back to that time. Interesting that it has just been in this broadening megaphone channel for the last, basically all of this century. So put that in your pocket. Want to close on futures because we got gold rocketing to another record high. That is the second record high in 2 days. And here's the old breakout level. And now we are heading towards 3,000, just $148 shy of that total. We'll have to see if the headlines can attract gold and the gold buyers to get that level fulfilled. Guys?
All right, Jared, thanks so much for breaking that down. It's time now for today's strategy session. Earnings season, well, it's well underway, and one of the key drivers for the market has been forward earnings estimates. That's according to Keith Lerner from Truist. We know that has very much been a huge focus on the street. Now, Lerner arguing with market valuations elevated that the ability of corporate America to deliver once again in this year will be key for the sustainability of that bull market. Let's talk about that with Keith Lerner himself, Truist co-CIO, a chief market strategist. Keith, it's great to have you back here on the show. So talk to me just about the trends that we've seen so far and whether or not it's enough to keep this bull market intact.
Yeah, well, great to be with you. It's always fun to start a Friday with you all. I love all the banter, and Jared did a great job with all these different formations, megaphones, and cup and handles. I love it. So going back to your question specifically, we've had all these different swings as far as sentiment on the economy. Are we moving too far, too fast about the elections? And as you mentioned, the key pillar, the most steady part of this bull market has been what you're seeing in front of you, those earning trends, those forward earning estimates every week are making new highs. And this quarter, we're seeing that continue. So, I will say, companies have continued to adapt when we've had this once-in-a-generation pandemic, once-in-a-generation inflation. And so far, the earnings beat rate this quarter is around 5% above expectations. And we're seeing it pretty broad-based as well. So all in all, we think the bull market trend is intact, supported by these earnings that are somewhat still underappreciated.
Is there a trading in the leaders of the bull market that you're anticipating for this year?
Well, we're seeing it. I think if you zoom out a bit, the biggest thing that I see that's shifted is just the broadness of this market. We have 10 out of 11 sectors up this year. And it's not just a U.S. phenomenon, right? Yes, so the U.S. is up. The average stock is up, small caps are up, mid caps are up, but international markets are up, emerging markets are up. So I do think maybe a big theme is, I think last year it's either or. What you're seeing this year is more of a broader theme. And from a sector strategy, we still like communication services. We still like tech. Maybe obviously tech's been under a little pressure, but we also like financials and we like mid caps as well. So I think it's just there's more opportunities. It's not just one or two sectors that are driving this right now.
Keith, when it comes to some of that uncertainty, and a lot of it just related to Trump policies and the impact that could have when you look at tariffs, the possibility of that this weekend, just it seems like the market has been discounting some of that risk. What is your assessment of just how that could potentially play out?
Yeah, when people think about tariffs and all the Washington uncertainty, there's two sides of that coin, right? Markets are all about expectation and how things come in relative to expectation. So if there's an expectation, let's take China as an example, that we're going to have 60% tariffs, and they come in and they're 10%, well, the market will respond positively, likely on that. And so far, what we've seen with Canada and Mexico, over the last week or two, look at the charts. They're actually up 4 or 5%. So I do think this is going to invoke volatility. At some point, he can't bluff. He's going to have to show the tariffs on there. But all in all, I think that investors should be thinking, okay, what's ground zero? Where are the expectations and where is that coming in relative to expectations? And sometimes that will actually create opportunities, not just a negative downside, which is what people have been fearing coming into this year.
Where do you think this market presents the most opportunity as we're closing out a positive January, it seems here? As long as DeepSeek doesn't do anything crazy today, I guess. But all those things considered, where are the largest opportunities that you're kind of charting at this juncture?
Yeah, and sure. And by the way, based on where we were on Monday, like when I looked just before jumping on the show, we were flat for this week. So that's showing money's rotating, but not leaving the overall market. We had huge inflows from retail investors actually on Monday. So listen, I would say longer term, we still like tech. We've been overweight communication services, which Jared just talked about making a new all-time high. I think don't give up on tech yet. I think tech is still a dominant theme. But other areas that we continue to like that are showing some leadership, financials mentioned earlier, with the economy remaining resilient, a steeper yield curve, deregulation, and we also like mid caps. We think we're going to see more M&A this year as a whole, and also with that resilient growth will be a positive. So again, we're spreading our wings as well with the overall market.
Keith, what's necessary to see that further outperformance within the mid caps?
I really think it's just to see continued resilience in the overall economy. And a lot of times when you talk about mid caps and small caps, it's really about sector composition. And when you look at mid caps, the biggest drivers of that sector is financials and industrials. So I think you'll need continued resilience on the economy for both of those sectors, which our economic growth rate expectations around 2.5%, slightly higher than the overall street. So I think that, and you will want to see that deregulation leading to more of that pickup in M&A, which has been somewhat quiet over the last couple of years. We think that's going to show a notable uptick this year.
Keith, since we mentioned DeepSeek and the sharp volatility that we saw on Monday, and now all the markets trying to kind of regain what we had lost, I mean, minus Nvidia, which still has some ground to make up there. Did that expose how much froth there is in the market right now?
It did expose that. I think there was a kind of this one-way view of technology. And again, we've been positive for some time now. We still are. In some ways, this creates some more tension in the stocks, which in some ways will be positive, because even what we just saw the last couple of days on the large cap earnings, some of them were good, some of them were just, people were braced for the worst, and they come in a little bit better than expectations. So you've had this reset of expectations, and then you've also seen this kind of movement within tech. So the technology sector is down, around 2.5% this week, but communication services, which is the Metas and the Googles and so forth, is up 2.5%. So you're actually also starting to see the market say, okay, where's the relative value? Where's the fundamental stories, and who's going to benefit and hurt? So I think that's a healthy side, that you're not just saying these are all one company, one sector. You're trying to find the relative opportunities in areas like software and other areas of the market beyond this just kind of one Mag 7 trade.
All right, Keith Lerner, always great to get your insight. Thanks so much for taking the time to join us here at this morning. As we head to break, we want to get a check-in on shares of Nvidia. Some breaking news: Yahoo Finance confirming with a person familiar with the matter that President Trump is planning to meet with Nvidia CEO Jensen Huang. That's happening at the White House later on today. Exact timing is unknown, but is expected to happen this afternoon. Now, this meeting coming after a new Chinese AI model from DeepSeek sparked some concern among technology industry leaders, tanking portion of the stock market earlier this week. We certainly saw many of those tech names, Nvidia specifically, under a tremendous amount of pressure earlier this week. Now, this meeting is a sign of Trump's growing commitment to rapidly evolving sphere of AI technology, and also coming at the end of a rocky week for the world's leading chip maker. But again, according to reporting here from Yahoo Finance's Julie Hyman, confirming that the meeting is expected to happen. It is actually in works now for quite some time, talking about this before the DeepSeek R1 release, and on the agenda is going to be AI policy in general. So again, we will look to bring you more updates as we get them, but again, very much a focus here for the market, for investors, for the tech community this afternoon. Jensen Huang set to meet with President Trump. We'll be right back. Shares of AbbVie moving to the upside here, up just about 8% after the drug maker delivered an optimistic outlook, raising its long-term guidance for newer drugs by $4 billion. Joining us now, we want to bring in Evan Seigerman. He is BMO Capital Markets Senior Research Analyst covering the biotech sector. It's great to have you here, Evan. So certainly, let's start with the results that we're getting here from AbbVie this morning. Clearly, the street very excited about some of the numbers that we're getting. We're looking at a pop in the stock, able to offset some of the concerns that we had going into this report, specifically around surrounding Humira. What do you make of the numbers that we're getting?
I mean, it's great to see 4Q earnings kick off like this. I think, the January has been a bit of the doldrums for the sector. What was most notable for us was, as you had mentioned, that guidance raise for Skyrizi and Rinvoq. We had hoped that could happen. I think on the flip side, their aesthetics business is a bit softer. We're listening to the call at the moment. I'm doing two things at once. We're trying to understand kind of what's happening there with Botox and Juvederm. We think that there could be some competitive dynamics at play in addition to some of the economic softening that they described.
So what does that mean in terms of how much you're going to anticipate them investing in terms of the newer products in the R&D pipeline?
That's very important because that is the lifeblood of this company and, frankly, how they got through the Humira LOE. If they just sat here and said, woe is us, Humira's going off patent, and didn't put money behind Skyrizi and Rinvoq, we wouldn't be in this situation today. So that's super important. They talk a lot about some of their efforts in oncology, some of their efforts in neuroscience. Yes, they had some disappointing news last year with their schizophrenia drug, but they are moving forward with other assets in Parkinson's and oncology.
What about Vraylar, the drug that was included on the list here for Medicare price negotiations? What are the implications there for AbbVie?
It's still TBD, right? We don't really know how the Trump administration is going to handle those price negotiations. I think that this was largely expected. You can kind of tell what may have been on the list based on Medicare sales. But I think that given the focus on Skyrizi and Rinvoq, they should be able to overcome any additional softness there. I'd also highlight there is an impact from Part D reform, a couple of percentage headwind, potentially with some of the Part D drugs. Again, likely mostly figured in at this point.
Evan, since you mentioned the Trump administration, I imagine to some extent you and your team have been following the confirmation hearings of RFK and the broader kind of pitch for Make America Healthy Again, which will also focus in on some of the biopharmaceutical companies as well. And just want to get your assessment on how that would translate through or flow through based on what we're hearing in his commentary, what's been campaigned on, and how biopharmaceutical companies should be assessing it.
Oh, there's a lot of questions. So we've been talking about this since last November when he was kind of put up as the potential nominee. I think there's been a lot of rhetoric over the past couple of days with the confirmation hearings. I've always said HHS is a very complicated organization. I'm still most focused on, the head of the FDA, potentially Martin McCreary. That's really important because that's kind of the critical agency for the biopharma sector. I think what will be interesting to see is how RFK or Dr. Oz, if he's head of CMS, implements the drug price negotiation or really kind of goes with that. Clearly, there's been a push and pull with the pharmaceutical sector. I think what I'm also focused on is, the whole kind of concept and issues around vaccines. I think he's softening because he understands how he needs to kind of be in this moment, but that is definitely something we're focused on. Not such an issue for AbbVie, but could be for Pfizer or Merck, for example.
Yeah, Evan, when it comes to Pfizer and Merck, those two stocks, how much of that downside risk has been priced in? Has it?
I mean, Pfizer's kind of hanging on the mid-20s right now. It hasn't really done much. Last year they did sell off a bit after kind of the RFK announcement. So I think that's pretty much priced in. On the Merck side, my bigger concern is actually Gardasil in China, which is not so much RFK. I think there's some rhetoric around kind of his whole lawsuits that he's kind of moving away from that. So for the most part, priced in with these two stocks as they've kind of been hanging out. They haven't really done much recently.
Evan, just lastly, while we have you, so much of the focus within kind of the pharmaceuticals and some of the more innovation breakthroughs that they've had, it's been around GLP-1s for the past year and change. Is it clear what the next big innovation to come forward from the industry could be?
Ooh, that is a tough one. I still think, GLP-1s are very important. In terms of what's next, we actually saw some really interesting data for a MASH drug earlier this week. And I think what we're going to see is, metabolic disease beyond just obesity. So MASH, that's a liver disease, potential for use in addiction. Of course, we have Zepbound approved in sleep apnea. So I think that's how you kind of expand the pie, because this metabolic dysregulation seems to be a precursor to a whole host of other diseases. And we'll get that data over the coming years to really build that case.
And I mean, real quick, before we let you go and jump back on the earnings call, I want to get your thoughts here on Vertex and the headlines out this morning. The FDA approving its non-opioid painkiller. Certainly it's significant, right? A milestone, many are calling it. And talk to us just why it's such a game changer and the impact that this could potentially have on the industry at large.
For sure. So we all know about the opioid crisis. I've talked a lot about it kind of in my research. And I think the fact that now we have a safe, effective, non-opioid pain medication that's been approved by the FDA for the post-surgery setting. So I think when you have, a wisdom tooth out, kind of some cosmetics procedures, that's a huge deal, because now we can give patients an alternative to opioids, get opioids off the street. There's been a lot of question around, are payers going to pay for this? My view is emphatically yes. I don't see a situation where a PBM or an insurance company can say, oh, you need to try the opioid first when your doctor gave you this option. I don't see that happening in this political environment. And I think that could actually be a tailwind for Vertex. My numbers are about $200 million for this year and go up to a couple billion over the next couple of years, even with the drug, pill price at about $15 per pill. So it's about $230 for a 7-day course. Not a huge amount of money, and I think it'd be a real interesting opportunity for the company.
Evan, always great to get some of your perspective and analysis of the industry. We'll let you get back to going and listening to some of these calls.
Sounds good.
Appreciate
Thank you so much. Have a great one, guys.
You too. Coming up, we're taking a look at some of the top stock movers today. That's next on Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go here. First up, ST Micro, considering cutting its workforce by about 6% through early retirements and attrition as the chip maker struggles with demand. That's according to a report from Bloomberg. The cuts would affect 2,000 to 3,000 workers involved in its operations in both Italy and France. The official announcement could come as soon as next month.
Plus, Samsung warning of slow AI chip sales in the first quarter as it faces increasing competition and U.S. export restrictions to China. Still, revenue was up about 12% from a year ago in the fourth quarter. The South Korean company, though, is saying that its operating profit dropped sharply from the previous 3 months as it ramps up R&D spending.
Finally, Colgate-Palmolive forecasting annual sales below estimates after missing on fourth quarter revenue. The consumer products company hit by weak demand in North America and Latin America. Still, for the full year, Colgate delivered over $20 billion in net sales for the first time ever. Shares right now down by a little more than 5%.
All right, well, that does it for Morning Brief, but keep it right here. Catalyst is coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Josh Schaefer. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, full coverage of the tech trade with earnings kicking off this week. What can we expect from the rest of the Magnificent Seven?
Plus, a look at the new regime for antitrust under the Trump administration as the DOJ sues to block HPE's $14 billion Juniper takeover.
And full coverage on President Trump's tariff plans, which are set to take effect tonight as the clock strikes midnight.
Big tech earnings in full swing. Apple topping first quarter estimates as Amazon gears up to report next week. Now, Apple's iPhone sales falling short, but results were boosted by strong MacBook and iPad sales. The tech giant also issuing a strong sales growth forecast as CEO Tim Cook touts the future of Apple Intelligence and the rollout to come. Now, when we talk about the impact that this could have on the stock moving forward, we want to bring in Tom Forte. He is Maxim Group's managing director and senior consumer internet analyst. Tom, it's great to have you back here on Yahoo Finance. So certainly the street's excited. You still have a hold rating, though, on the stock. What's keeping you on the sidelines?
Yeah, so thanks, Shauna. So when you look at the valuation for Apple's shares right now, it's trading at north of a 30 times PE multiple, and EPS growth is, call it, mid-single digit or high single digit. And I think if we've learned anything from the last two quarters, September and December from Apple, it's that mismatch in the timing of the hardware rollout, meaning the 16, and the software rollout, everything having to do with AI and Apple Intelligence, has weighed on iPhone sales. So it isn't clear to me yet that we're going to get this super cycle or much less an upgrade cycle from AI. And that's why I'm sitting here today with a hold.
Tom, I'm curious, looking at the market earlier this week before earnings, there seemed to be a little bit of sentiment that maybe DeepSeek was actually good for Apple and worse for some other AI names. How do you read sort of the DeepSeek developments and what that means for Apple's AI story, if anything?
Yeah, so Josh, I do think that part of the strength in the shares today is that on a relative basis, Apple's less negatively impacted by the emergence of DeepSeek, certainly than Nvidia and others in mega tech land. So if you look at comments yesterday from the company, they talk about their hybrid CapEx model. What they're basically saying is that they spend some money themselves, but are also able to leverage others' CapEx spending. So they're less, they're not ramping into CapEx nearly as heavily as Meta, Microsoft, or others. So DeepSeek is less of a threat to Apple. And I think you're seeing kind of a small relief rally certainly versus Nvidia and other big tech companies.
Let's talk about some of the other big tech companies and zero in on Amazon. I believe it's a top pick. You're making the argument it's the best position among the mega cap tech names. Why?
Amazon, in my opinion, is clearly the best positioned. So think about artificial intelligence and what it means to Amazon. It means they're able to sell it at the enterprise level through their cloud computing AWS business. They've been using it for years to improve their e-commerce sales. And then over time, they're going to increase their automation at the fulfillment center level, which is going to reduce their expenses. So this ability to use AI to both drive profits, sales, and then also to lower expenses, I think that's unique to Amazon and why they're best positioned when it comes to exploiting AI.
Tom, I'm curious, when we talk about Amazon as an AI pick, and I guess you could argue this with a lot of the Mag 7 companies, but Amazon has so many different webs to this business, right, that maybe have to do with AI, but don't have to do with AI at the same time, right? How are the trends looking in just Amazon's traditional consumer sales business or their investments in video, like the other parts of Amazon's business that maybe aren't necessarily directly AI tech, if I'm an investor looking at Amazon as a company?
So the December quarter, Josh, is historically the big quarter for retail sales. And I would say that they're doing relatively well. It's been a challenging macroeconomic environment in the US and elsewhere. You can see it because Amazon's having multiple sales, including during the December quarter. But what really is driving the stock, independent of AI and cloud computing, is advertising. And they're doing a great job. They're doing a much better job, certainly, in advertising than Google and Facebook are doing in e-commerce. And I think that advertising story, independent of AI, is also what's driving shares of Amazon.
Let's talk a little bit more, though, about AI, given the DeepSeek development this week and given even the update that we got from Andy Jassy over the last 24 hours now saying that DeepSeek is going to be available on the AWS platform. How should investors be looking at that?
Yeah, so what it means for Amazon is it's multi-leveled. So they have a minority interest in Anthropic. They also, incidentally, have a minority interest in Rivian. So it reminds me of the kind of the early days of e-commerce where Amazon had these minority investments in other e-commerce companies that ultimately folded and didn't make it. But what drives the performance of the stock longer term is the operating results of Amazon. So I do think that there's this incremental risk of the emergence of DeepSeek for Amazon, given that they had this minority investment in Anthropic. but I think the stock can continue to do well even if Anthropic is negatively impacted by DeepSeek. And I'm not surprised that Andy wants to give the enterprises on the platform an opportunity to save money by potentially using a lower cost alternative. Andy was early in talking about these large language models can be quite expensive, and giving enterprises the ability to use less, save money, is one thing that they're proud of at AWS, and one thing that I think separates AWS from others.
You know, Tom, just digging into what you just had to say about Anthropic, we had a former employee of OpenAI on the program yesterday, and he was very optimistic just in terms of what it means for overall adoption, just increase usage that will likely come from a cheaper model, obviously, and the fact that this is likely just the beginning. Is it necessarily, a negative for names like Anthropic and OpenAI, or is this ultimately a positive in the longer term, just in terms of that cheaper development?
Yeah, so the argument would be greater usage over time. So think of it as price times quantity. If the price goes down, but the quantity skyrockets, then everyone will be okay. But it's hard for me to envision today that this is good news for OpenAI, that this is good news for Anthropic, that you have an emerging competitor coming out of China who seems to be showing that it can do similar things at 1/10 the cost, So again, price times quantity, greater quantity in the future can offset lower price, but I have a hard time seeing this as anything but a net negative for OpenAI and Anthropic.
Tom Forte, we're going to have to leave it there. Appreciate you joining us today.
Thank you, anytime.
Over the past 2 years, the Magnificent Seven has significantly outperformed the broader S&P 500, rising more than 120% over that period. But can the magnificence of the Mag 7 really last? Our next guest, Global Fund's top holdings include 6 of the 7 magnificent names. John Belton, Gabelli Fund's portfolio manager, joins us now. John, I want to start with sort of what I feel like is one of the hot debates for this year is whether Mag 7 keep outperforming or we get sort of this broadening out of the rally. And as Bank of America put it today, they become the Lag 7, right? And they're not necessarily outperforming the index anymore. Where do you sort of stand on this debate in terms of Mag 7 outperformance and if that can continue?
Thanks, Josh. Good to be with you virtually. I think the Mag 7 has really, really strong fundamentals. I'd start there. And so long as those fundamentals continue, I don't see valuations here looking particularly stretched. So I think we take them case by case, can talk about any of them. But I do think right now these companies are showing really solid top line fundamentals. They're clear AI beneficiaries. They're expanding margins. They've got great capital allocation policies. It's kind of hard to find better positioned companies right now. So that's sort of the default lens I have when I think about this year.
Is that the case for Nvidia too?
I still think Nvidia is incredibly well positioned. I think a lot has been made about this DeepSeek's new models, which were first released a month ago. I still think Nvidia plays really well with DeepSeek. They're still the primary arms dealer to not just the generative AI industry, but to the broader AI and machine learning industry. I think Nvidia, if you look at just on headline valuations, it's one of the cheaper Mag 7 stocks here. So I still feel pretty good about Nvidia.
John, I want to pull up a chart. This is a chart a lot of strategists often show me when they're talking about sort of this broadening out, right? It's the look at the Mag 7 versus sort of the 493 earnings estimates, right? And it's consensus, right, at least from FactSet. We're supposed to converge a little bit this year. And normally someone would say, well, you'd probably want to buy the green line, right? Earnings are coming up and you're looking at earnings slowing for the Mag 7. I guess why isn't that the case, and why isn't that necessarily just kind of the easy read through when you look at earnings estimates?
Well, first, I can't quite make out all the details in your chart, but I think what the chart's telling me is when we look at 2024 as just kind of a historical context, the Mag 7 drove something like 35-40% of the S&P 500's return, if memory serves. Drove more like 65-70% of the index's earnings growth. And on balance, the Mag 7 had positive earnings revisions. The 493 had negative earnings revisions. So I guess just to frame the question, I'd start by saying Mag 7 driving way more of the earnings growth than the stock price performance growth. and having positive earnings estimate revisions versus the rest of the market having negative estimate revisions. When I look at the go forward in your chart there, what that tells me is the market's baking in some pretty good acceleration for the 493 and is expecting deceleration for the Mag 7. So I think you could argue that, expectations look pretty achievable for the Mag 7. And obviously it's a market of stocks, not a stock market. Every stock has to be taken case by case, but the market's banking on acceleration among the 493. So we'll see if that happens, but feel good about the Mag 7. They've been over delivering. Don't really see a reason why now they would stop over delivering.
And when it comes to sort of the argument that also fits within that of large caps continuing to outperform, right? Maybe if we stay in sort of a higher rate environment here, people sort of like going with those heavy cash flow companies, great balance sheets. Where do you sit on sort of that level of things? Is that also part of the argument you're making here?
I mean, again, so I personally am more of an individual stock picker, so I don't think about things in such broad strokes. But what I would say is, I think a lot of the largest companies right now have great fundamentals. And even when we look at kind of valuations in historical context, I think take the Mag 7 again. The Mag 7 valuation currently, yeah, it's rich versus history. I think it's kind of like a 80th percentile type valuation versus history. But if memory serves, the 493 is actually trading at a richer valuation versus history. So it's not to, pitch Mag 7 and nothing else, but it's just to say, again, I don't see valuation in a vacuum as a reason not to like Mag 7.
John, what do you view then as the biggest risk then to your bull argument when it comes to tech? If we're not worried about valuations, if we're not worried about some of the other factors that have very much been laid out from other strategists on the street, what is that one thing that investors should be keeping in mind?
I'd say probably two things from a macro standpoint. I do think inflation and reflation, more specifically, is still the greatest risk that the stock market faces as a whole over the near term. I think for tech and for big tech specifically, I think artificial intelligence is something that is very exciting. It still, I think, is in early innings, but there's definitely a lot of expectation built in there. And, I think we are going to have to start seeing some useful end user facing products and applications come to market to make investors comfortable with the amount of investment that's being deployed towards this technology. So I think artificial intelligence would be both a big risk, as we saw this week, but also a big opportunity.
All right, John, great to get some of your time here this morning. Thanks so much.
Thanks for having me.
Well, it's already the last trading day of January, and according to history, this month's performance could make or break the rest of the market's year. No pressure. Markets editor and host of Stocks in Translation, Jared Bliggery, joins us now to explain it all. Jared.
Thank you. No pressure. The first month of the brand new quarter century is nearly in the bag. And barring a big surprise today, the world's benchmark stock index, the S&P 500, is going to close green. For investors who pay attention to history, January is a special month as it holds predictive power for the rest of the year. As January goes, so goes the year, said Yale Hirsch in the Stock Trader's Almanac way back in '72. And what Hirsch discovered half a century ago is a prime example of seasonality, or the tendency of markets to repeat certain patterns year after year. In fact, there's a big historical difference in what happens from February to December, depending on how January goes, which we can see in this chart. And let's advance this here, and we can see when we have a negative, or actually, let me just say first that this comes from Ryan Dietrich at Carson Group, and then when we have a positive January, they have steady returns on average throughout the rest of the year, with a fat 17% return overall. And that's a pretty big difference for years that start off with a negative January. They lose 2% on average. And yes, those totals happen to include what happened in January. But if you're interested in exactly what happens February to December, we've got that too right here. Again, thank you to Ryan Dietrich. The rest of the year is up 87% of the time with an average gain of 12%. That's for positive Januaries. And that drops to 60% positive and 2% gains for negative Januaries. And that's a statistically significant difference, as the quants say. And for those who are wondering exactly what to buy, let's see what this has been trending this month. And we're going to go to our sector action, and we'll pull up 2 different time frames here. We'll do last 9 days, and that happens to be the time since the inauguration, and we'll also do year to date. And there's actually quite a bit of overlap between the two. And why the inauguration? Because there was a big dollar reversal that day, and regular viewers might know that I saw some shift changes in the market. But regardless, number 1 here on our list is communication services. That houses Meta and Alphabet. As I was saying earlier today, it is on a 10-day hot streak along with Meta, and you can see it's up 6.1% over these last 9 days. Second is healthcare. Healthcare is really broken out nicely. I'm going to show you a 1-year chart and why I'm excited about the technicals this year. Here we go. From the middle of last year to basically the beginning of this year, it was in a downtrend. It is now broken out, and it has analysts excited too. I've talked to a number of them on stocks in translation. And then financials, staples, and consumer discretionary round out these sectors. Now, to the downside, we want to be careful. Energy and utilities have both lost a bit of money. And by the way, tech is almost flat here, as you can see. Just to close, I'll pull up the year to date, and as you can see, everything in the green. The bottom line here for investors is that when we have a positive January, we do tend to have the possibility for nice returns into the end of the year. This is year 3 of a bull market where we've seen the first 2 years up more than 20%, and there are a lot of hopes, and for now they're just hopes, that we'll have another year, a 3rd year of 20+ returns.
Jared Blickery, some high hopes for sure. Appreciate you bringing that one for us. And a reminder to our viewers, Stocks in Translation with Jared Blickery airs every Tuesday and Thursday at 8:30 a.m. Eastern Time. Coming up, we're taking a look at some of today's top trending tickers, including Nvidia's CEO set to meet with President Trump later today.
Now time for some of today's trending tickers. Scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, sources telling Yahoo Finance's Julie Hyman that Nvidia CEO Jensen Huang will be meeting with President Trump today. The two are expected to meet this afternoon to discuss artificial intelligence policy. Now, sources saying that the meeting has been in the works since before the DeepSeek-driven rout that triggered Nvidia's stock to have its worst single-day performance. You're looking at Nvidia shares reversing some of those earlier earlier declines that we saw in earlier action here this morning, are now looking at gains of just about 0.8%. Clearly, AI policy very much is going to be in focus. That is a no-brainer here for these discussions. But again, when you talk about the impact of what this could have and ultimately the importance of this meeting, clearly Nvidia has very much been the target here of the Biden administration, potentially the Trump administration, just in terms of some of the curbs that have been implemented, clearly having an impact on their most advanced chips. So would be advantageous to have Nvidia CEO travel to the White House. He has been very open, saying that he would be willing to meet with President Trump. He was asked about that earlier this month. So again, all eyes will be on this meeting and any development out of that.
Yeah, and it was just a report, right? We didn't get full confirmation on this, but it was a report from Bloomberg out on Wednesday that had sent Nvidia shares lower as well, talking about additional curbs that the Trump administration had been considering. So it was in early stages, but they were considering additional curbs on Nvidia's sales to China that would actually impact one of the chips that Nvidia currently sells to China under the Biden restrictions. But I think, Shauna, this all brings up sort of an interesting point post DeepSeek that I've been thinking about a lot, which is I understand why you wouldn't want Nvidia's AI chips perhaps going to China if you're going to have sort of this AI war going on between the two countries and who can build it the fastest, right? But also hurting the American business by not letting them continue to grow and sell chips there might not help our AI companies grow as much. And I just feel like there's two sides to this, right? And it's not an easy way to just say it makes sense for US companies to not sell chips, AI chips to China. We don't want them to use our chips. I don't know if it's that linear of an argument when you think about the different dynamics at play here.
Well, certainly it's the national security argument versus the revenue argument and the bottom line impact that it's going to have on so many of these companies, which is why we've seen so many from the chip sector just be very communicative and outspoken just about the impact that this could have on revenues down the line. I think it's also going to be interesting to learn a little bit more just about how President Trump is thinking about all of this. Because even his commentary on DeepSeek, saying that it was, I believe he called it a wake-up call for the industry, but then was also complimentary, maybe you can even go as far as just saying that this is actually good news here just in terms of wider adoption, very much the argument that we have heard here on Yahoo Finance time and time again. So again, what those new AI solutions that he has touted, what that future investment infrastructure could potentially look like here, specifically geared towards AI, and then of course counterbalancing that with some of the more hawkish rhetoric that we've gotten on future curbs, of course. Clearly front of mind for not only these larger tech CEOs, but clearly for investors, for analysts as well.
Yeah, we've already had one large announcement from this administration about investing in AI here in the US, right? That $500 billion investment. What more are we going to hear as we carry on here, I think will be key to probably watch next week. Of course, we're talking a lot about tariffs, but we talk about the stock market here, and I think the AI Trump story is going to continue to keep rising to the forefront. But there's always time to talk about Nvidia. Today, we got to talk about Visa, Shauna. Visa shares heading higher this morning after the company reported stronger than expected profit in the latest quarter. Visa's CEO saying the company saw, quote, healthy spending during the holidays and an 11% increase in transactions. This also comes days after Visa announced a partnership with Elon Musk's X aimed to increase financial service offerings from the social media platform. So Visa shares up about 1% today, but there seems to be a little bit of a positive read-through here on holiday spending and the consumer. I think that's been a trend through a lot of these earnings we've seen so far, Shauna, is there was clearly no holiday spending drop-off when it comes to these different companies and how spending ended the year. Seems like it was pretty solid. I would expect to hear probably something similar from Amazon next week and the different consumer companies as we carry through earnings season.
Yeah, I think maybe a bit of a surprise just given the macro pressures that we've long heard about and long talked about here over the last several quarters here. But when you take a look at Visa and some of the read-through that we're getting, at least the initial reaction that we're getting from some of the analysts on the street, Jefferies was one of the names that was out very complimentary and very upbeat in terms of what we're learning here from Visa this quarter, saying that it was a more sanguine regulatory environment, that the story is cleaner than it's been at any point in the last year plus. And I bring that up because the regulatory environment has very much been front and center. When you've heard many of the bullish arguments made on Visa, made on some of its competitors, it's very much surrounding the regulatory environment under President Trump and that looking much more favorable than what it did under the Biden administration. So here we are entering a quote unquote new era for many of these companies, and that clearer path forward is enough here to get excited and obviously contributing to some of that guidance.
How clear is that path of the regulatory?
Well, and that's
environment,
also the big right. If they're too optimistic, right?
We should talk about that next. I think
we will. Don't worry, we've got a lot more coming up. Next up, the first antitrust suit filed under Trump 2.0. What it could mean for the future of deals. We're going to get that next, coming up on Catalyst. The Justice Department suing to block HPE's $14 billion acquisition of Juniper Networks, alleging that it would harm competition. HPE and Juniper are responding to the filing, saying, quote, "We believe the Department of Justice's analysis of this acquisition is fundamentally flawed, and we are disappointed in its decision to file a suit attempting to prohibit the closing of the transaction." Now, this coming after HPE CEO Antonio Neri has repeatedly reiterated his confidence that this deal is going to get done to Yahoo Finance. Here's what he told us just last week in Davos.
We are working with now the new administration, and we feel confident that we will get this deal through.
All right, joining us now, we want to bring in Bill Baer. He's the former United States Assistant Attorney General. Bill, so Antonio, to no surprise, obviously has remained very, very confident that we are going to get this done. I think maybe this news yesterday came as a bit of a surprise given it's happening under the Trump administration. How do you see this playing out?
Well, this is pretty much mainstream antitrust merger enforcement. It is not something that's out of left field or left wing. It is two of the three major suppliers of these enterprise solutions combining. After the deal, you will have two firms, the combined Juniper, Hewlett Packard, and Cisco, controlling well over 70% of the U.S. market. Under antitrust law, that's presumptively unlawful and problematic. So it's an interesting first move by the antitrust division under President Trump. We'll see what it portends for the future.
Bill, it sounds like you don't think the deal's going to get done then, right? And it's going to get blocked?
Reading the complaint, these two firms, Juniper's a relatively new firm to this market, but it's done very well. And the complaint lays out ways in which Hewlett Packard and Juniper are aggressively competing with each other today. That's lost. The companies say, they're going to save a whole lot of money, efficiencies from this deal, but it doesn't mean consumers and the businesses that buy from these two companies are going to do better. And that's really what antitrust is all about, separating what is beneficial to shareholders but maybe bad for competition. So my bet, and I'm not a betting man, but my bet on this one is I think the courts are likely to be sympathetic to the government's challenger.
So, Bill, we mentioned that this is a first suit brought under the Trump administration. Then is it too quick, just given the arguments that you've laid out, too quick to then jump to the conclusion that maybe this signals the Trump administration is going to be a bit more aggressive than maybe initially expected?
I think it's too early to tell. It's just one tea leaf here, and we got to look at a whole bunch of them to see what the trend is going to be. But the point I made at the outset, I think, is worth thinking about. This is sort of mainstream merger enforcement. It's the kind of case that Republican administrations and Democratic administrations would have brought. So it's not novel. It's pretty much straight down the path.
Bill, I'm curious broadly what you make of what feels like has become consensus that mergers and acquisitions will be easier to sort of get to not get blocked, essentially, right, under President Trump. I mean, do you agree with that general consensus? I was looking at a story from our Alexis Keenan. She was pointing out that the DOJ and the FTC brought 118 M&A challenges between 2017 and 2019 under Trump, pretty similar to what you saw under Biden. It's not like they were letting everything go through.
I think that's right. There is more consensus than a lot of people in the business community might think about what constitutes antitrust harms, what M&A activity, particularly when rivals merge, should be challenged. And those figures you just cited tend to bear that out.
But what do you think investors, when they're trying to, and following up on what Josh was just asking there, how should then we be thinking about the regulatory framework going forward? Is the market then maybe a bit too optimistic just in terms of how much activity we could potentially then see over the next 4 years, or is it very much a sector by sector basis?
It's hard to figure out what the macro trend is going to be, and you don't know what M&A activity that had been on hold during the last 4 years might be tried now. That I assume the business community will legitimately test the limits and pursue some deals that probably would never have gotten out of the boardroom 2 or 3 years ago. So I expect more activity. It takes a while to figure out what is getting seriously investigated and what is being allowed to go through. But I'm not surprised to see companies rethinking their acquisition strategies and being more aggressive about them.
Bill Baer, we're going to have to leave it there. Appreciate you joining us today.
All right. Appreciate it. Thanks, folks.
Coming up, with President Trump's proposed tariff plan set to begin on Saturday, February 1st, we're doing a deep dive on the potential impact of those tariffs on foreign relations, consumer products, and luxury products. That's next on Catalyst.
I'll be putting the tariff of 25% on Canada and separately 25% on Mexico. And we will really have to do that because we have very big deficits with those countries. Those tariffs may or may not rise with time.
President Trump reiterating his plan to impose 25% tariffs on Canada and Mexico. Now, when you take a look at the impact that is potentially going to have, we will be covering that and what this potentially means for the U.S.'s biggest trading partners, how they could affect this, foreign relations, consumer goods, and luxury retail. Josh Schaefer standing by at The Touch for a breakdown of what we could see. Josh.
Hey, Shauna. Yeah, let's start simple. Tariffs are taxes imposed by one country on goods imported from others. In the simplest terms, they're used to collect income, reduce competition from domestically made products, and place an economic burden on foreign exporters. For that reason, they're often used as bargaining chips. Former President Biden actually used a few selective tariffs during his presidency against China to support American manufacturing of semiconductors and solar panels. But the key word there is selective. Only on certain products. The tariffs President Trump is calling for are sweeping, and the implications are much broader. Mexico, China, and Canada are the U.S.'s largest trading partners. If the proposed tariffs are implemented, a slew of goods like cars and electronics could get more expensive, and so could raw materials. So when the costs go up for aluminum, oil, and steel, even if something is made in the U.S., manufacturers could pass on that cost to American buyers. In tandem, oil prices also could spike higher. Canada is America's largest source of petroleum and crude oil, supplying about 52% of the U.S.'s total imports in 2022. That's according to the EIA. President Trump said last night he will make a determination on whether oil will be part of the tariff plan, saying it depends on what the price is. Could the U.S. get their goods somewhere else? Eventually, maybe. But building factories and reorganizing global supply chains takes time. In the meantime, Americans may end up paying much more for everyday items. Shauna, back to you.
All right, let's get a deeper dive on how these tariffs are set to take effect and the impact it's going to have on foreign relations. We want to bring in Sarah Bianchi. She's the chief strategist for international affairs and public policy at Evercore ISI. Sarah, it's great to have you. So I think the first question is so top of mind for investors right now. If these were to go into effect, what are the implications of that?
Well, if a 25% across the board tariff would go to effect, that would be very significant for the markets, particularly the auto industry. In Mexico, we import a lot of even U.S. Auto parts and production. A lot of that is in Mexico, so certainly hugely impactful for GM, Ford, and others. And then, of course, on the oil side, as was mentioned in Canada, very, very significant. So these are very intertwined economies, and this would, if left in place for a significant period of time, would definitely cause huge economic and market impacts.
Sarah, excuse me, sorry. Sarah, coughing. Sarah, how likely do you think it is that we see these tariffs go into place, say, right at midnight tonight, or that the tariffs are actually in place when we come back after the weekend? What sort of timeline do you actually think is likely to play out here?
I don't expect the tariffs will be in place on Monday morning or on Saturday. Typically, what I expect the president will do, if there is not an arrangement or deal in and around border security and other priorities he's seeking to deal with, is that he will do some kind of executive action on Saturday that signals that the tariffs are coming into place by date certain. And date certain could be a week, 2 weeks, 30 days. The reality is it actually takes some time to get the customs folks to put in tariff lines and to put that in their system. So that alone should take about a week to 10 days. And then the president may want to leave some additional room for negotiation. So I think that what we're going to see Saturday, if there is no deal, is a signal that tariffs are coming with a date certain. That still leaves parties time to negotiate an agreement, and he can withdraw them. But it is more serious and further than he has gone at least in the early stages of term two. So I do think it will certainly catch the market's attention.
Sarah, the read here from the market, it's been interesting to me because they're very much discounting what happened during the first Trump administration. When you break it down, he did follow through on some of these tariffs, yet the market doesn't seem to be buying it this time around. Why is that?
Well, it's a great question. I think people were surprised that he didn't do anything day one, and therefore maybe took that as a signal. Even though we still believe all of this agenda is coming. The market is right that often when President Trump, he uses tariffs in different ways. And often when he uses it as leverage for another policy priority, like we're seeing here and like we did see in one, a lot of times in those cases, he didn't actually follow through. And a 25% across the board tariff is extremely significant. But I do think, again, if we don't get some agreement on the border today or tomorrow, that he is going to take this next step of saying an executive action that these are coming. And my sense is that will, like I said, grab the market's attention. It may be further than they are expecting at this point.
Where do you think things play out then over the next couple of weeks? Do you expect that there would be ongoing negotiations? I know they could continue to negotiate, but do you think that's what would happen? And would the market sort of continue to react to those specific negotiations and those headlines that we'd be getting out? We're not really leaving sort of this realm of uncertainty for a little while here.
Yeah, my expectation is that there would be continued negotiations. As I understand it from what the president and his team has said, they are feeling better about where things are standing with Mexico. They are making some moves. So I do think you could see a deal there. Canada's in a little bit different situation given they've got their own politics going on right now. And so perhaps a little bit less focused on precisely what the president's asking for. But for both these economies, it's certainly better to negotiate in and around things like opioids, immigrants, particularly Canada, where this is a little bit less of a pressing issue. I would expect them to negotiate and make it so that these tariffs won't go into place. That's really not good for anybody. Again, given how integrated parts of these economies are, it would cause quite a bit of economic turmoil.
Yeah, certainly. All right, Sarah Bianchi, thanks so much.
Thanks.
Coming up, we'll be discussing the potential impact of tariffs on consumer goods and luxury products. That's coming up next on Catalysts.
Tariffs and their potential impact on pricing and sales are a popular talking point once again for business leaders. The number of tariff mentions on earnings calls this quarter approaching 2018 levels. For consumer goods companies, we heard from Colgate this morning saying they plan to assess and mitigate any impact of tariffs where they can. And Procter & Gamble CFO has said what can't be offset with productivity will be offset through incremental pricing. Joining us now is Filippo Falorni, the lead analyst and vice president of U.S. Beverages and Health and Personal Care at Citi. Filippo, I promise we're not talking gambling, we're talking Procter & Gamble. But I want to start broadly with tariffs. And as you look at this consumer space, how do you think tariffs impact the sector and sort of sort through which companies get hit the most and which companies might not be impacted that much?
Yeah, absolutely. Thanks for having me on. Look, the tariff debate has been very important in my space since really Trump's election in last November. And really, there's a different companies that we've been studying and kind of trying to understand the impacts. I think Constellation Brand is the one that comes up the most within beer because they do manufacture the entirety of their Mexican beer business in Mexico. They have 2 locations currently of breweries and a third one in construction. And therefore, they will be clearly severely impacted by the tariffs. They would also be in a relatively disadvantaged position because most of their competitors would not have to take pricing in result of tariffs, given they compete with Anheuser-Busch or Molson Coors, which manufacture beer domestically in the U.S. So they're clearly the most exposed in my coverage. Brown-Forman is another one. For them, it's mainly a retaliatory tariff. Obviously, if the U.S. puts tariffs on the European Union and some other countries outside of Mexico and Canada, they would also be impacted by potential retaliatory tariff. And obviously, they export American whiskey with Jack Daniels into Europe and other parts of the world. So that would be the biggest risk, in addition to the tariff on their tequila business, which obviously it's imported from Mexico. And then you mentioned Colgate and Procter. They typically have more local production across the world, but they do import certain products. For example, Colgate, they manufacture some of their toothpaste in Mexico. So they would also be exposed. They haven't really quantified the amount of manufacturing that is done in Mexico. But obviously, as they talked about today on the earnings call, they will look to mitigate the impacts. But if they can, they will result in higher prices for consumers.
Filippo, how much margin, though, is there for these higher prices to be passed along to the consumer versus many of these consumer staple companies just being forced to eat some of that higher costs?
Yeah, that's a good question, Sean. I think, look, we're coming off 2-3 years of very elevated prices, as you can see in the CPI over really the last 2.5-3 years. Now companies are trying to shift towards volume growth and so reducing the amount of pricing that is taken in the marketplace. But ultimately, look, they will pass at least a portion of the tariff. That's typically what has been happened in the prior examples, also in 2017, 2018, in the first Trump presidency. So I would expect them to pass at least a portion, probably not the full amount, but you will definitely see inflation coming back in many CPG categories.
Filippo, we've been talking a lot about sort of what's priced into the market here with tariffs, right? And let's roll through. Maybe we don't get 25% tariffs on Mexico and Canada, as President Trump has said. Are there stocks that have been significantly beaten down by the talk of tariffs that are sort of intriguing to you from that perspective?
Yes, absolutely. If you look at Constellation Brand, that stock is down over 17% year to date. Tariff has been one of the major concerns. Their fundamentals were also a bit softer last quarter, but really the tariff risk is predominant for them. And as I mentioned, they are in this competitive disadvantage if tariffs were to be implemented. And so on the other side, if there's no tariffs, that's the one that I think could probably see the biggest positive reaction in case of more of a negotiation between Mexico and Canada, potentially to, again, renegotiate the USMCA deal.
All right, Filippo Falorni, always great to get your insight. Thanks so much for joining us.
Thanks for having me.
Luxury brands are also eyeing the impact of potential tariffs. Now, Davos, Ralph Lauren's CEO, spoke with Yahoo Finance about his company's exposure specifically to China, warning that a tariff would be a pressure point here for the retailer. Let's take a listen.
China has some unique expertise in certain categories for us. Some of our more sophisticated sweaters are made in China. Some of our more sophisticated footwear is made in China. I think under duress, we could always find alternatives. And as you can imagine, we're running all types of scenarios to be prepared.
Well, what these tariffs could mean for the luxury sector, we want to bring in Marcus Hansen. He is Von Topel's a portfolio manager. Marcus, it's great to have you here at the desk. So help us make sense of this. We were having a debate in our morning meeting just how exposed luxury retailers are to the threat of tariffs. Obviously, given the fact that Europe is not included in the threat this weekend, how should how should investors be thinking about that?
Absolutely. So great question. So if you look at the European luxury goods companies, and by the way, it was worth noting that Mr. Arnault, who's the biggest shareholder and runs LVMH Group, was at the inauguration with members of his family. The US is a very important market. For the bulk of the luxury goods companies out of Europe, they manufacture 95+% of their products in Europe. The beneficiary of recent weeks has been the devaluation of the euro. Since the election, the euro is down 10%. This is why if you go to Europe, you're seeing it's almost like the Normandy invasion of Americans coming over to shop and go skiing. So that's good news for the businesses. As far as production and other things, look, at the high end of the kind of companies we like, who've been through ups and downs, recessions, pandemics and so forth, the likes of Hermes, Richemont, which owns Cartier and Van Cleef, Brunello Cucinelli, the king of cashmere, their customer base generally is not impacted by increases of prices mid, high single digit. They'll do fine. And if anything, the euro offsets any impact of some near-term tariffs. It's really more the mid-range where there is an impact and where maybe you'll trade against something else. You just had the CEO of Ralph Lauren on TV, fantastic CEO, has done a great job with the brand. They could actually benefit in the US maybe from some other sort of competitor moves. But overall, the luxury universe is driven by the growth in high wealth net individuals. The wealth factor, if you look around, stock market all-time high, real estate all-time high. People, there's this vibe session effect. They talk bad, but people feel good. And if you go out, bars are full, restaurants are full. That's playing to luxury goods. And in the recent batch of results, and I think last time I said we were talking about this ahead of this, the US in particular stood out as particularly strong. The US is about 25-30% of market for a lot of these guys. And it continues to be an area where they feel there's still lots of traction to go. And by the way, at the same time, China's less worse. So you've got a nice combination offsetting. But where you're seeing it first is in the currency. And for now, that's actually playing to the Europeans because of that devaluation effect.
So I know we haven't really moved the tariff conversation from Mexico and Canada necessarily to Europe, right? But how bad would the tariffs have to, like, what is the case where tariffs are bad enough that it would be a concern? And is that even something you're considering on the table?
Look, you've seen the initial broadside against Canada and Mexico, that sort of 15, maybe 20, 25% number. Could be part of negotiations. Remember, specific to that, that's also maybe part of the USMCA agreement that's coming up next year. With Europe, you are still also seeing this discussion about US selling energy to Europe as part of an offset against tariffs. Remember, Europe used to import a lot of energy from Russia. That's been shut off. LNG exports now from the US, the biggest single market is to Europe. So I think as part of this administration, that trade is out there. Would I be surprised if we see a similar number? It's part of this administration's decision in terms of not just trade, but also negotiation. It could happen. But coming back to the overall impact, part of that's mitigated. I mean, we've had a 10% move in the euro. So you could almost argue if I come out tomorrow and say 25%, it's actually 15. But net, these companies, particularly at the high end, do have an amazing pricing power. Remember, none of these companies have been around for almost 150 plus years. They've seen a lot, world wars, recessions, ups and downs. Tariffs are not new either, by the way, as well. If you look at European luxury companies, sales to China and other markets in emerging markets actually are taxed with luxury tax effects. So I'll give you another example, Ferrari, the car company. If you buy a V12 Ferrari in Italy and then buy it in China, the cost in China is 3 times because of taxes. So tariffs aren't new. Companies have seen this, and particularly in luxury goods, you see a lot of luxury taxes across the board. But headline-wise, yeah, it would be a negative.
What are they doing are they doing anything to further diversify their supply chains? Because we know LVMH obviously manufacturing some of their goods here in the U.S. How are you looking at that and how that evolves?
Absolutely. So maybe with Mr. Arnault's visit to the U.S., he, if you remember during the last administration, I think actually President Trump actually went down to Texas at the opening of the store. The opening of the manufacturing facility. They have 2 in California as well, so there's 3. I wouldn't be surprised if you see some of that move over. Again, it's not for the super high-end stuff, because at the end of the day, if you're paying $3,000 plus, you want to see the made in France, made in Italy, the artisanal. But certainly for entry level, it makes sense. And again, the US market is a market where a lot of these companies still see a significant upside, both in terms of the take-up of luxury goods and the penetration of demand. And where you really start that is entry-level products, $300, $400, $500. Manufacturing's there. Texas, by the way, as a local market, is a huge growing economy. It's been the fastest growing economy within the United States. There is demand there. Luxury goods companies 10 years ago did not have stores in Austin. They do now. Why? Because things are moving. So keep in mind they're also looking politically and economically to be present in the US.
All right, Marcus, always great to have you. Thanks so much.
Good to see you too. Thank you.
Keep right here on Yahoo Finance. That does it for us. But Wealth is coming up next, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you on Monday.
It's time for Yahoo Finance's Market Minute. The tech-heavy Nasdaq leading U.S. stocks higher to end the week. Shares of Apple leading that gain after it posted a first-quarter profit beat. Both sales in China and for its coveted iPhones fell short of expectations, but investors optimistic about its revenue outlook. Shares of Decker Outdoor falling this morning. That's the company behind shoe brands like Hoka and Uggs. It beat third-quarter estimates, but investors are worried about a slowdown in sales for its fiscal fourth quarter. And shares of Walgreens falling as much as 17% this morning after the pharmacy chain suspended quarterly dividend as it attempts a turnaround strategy, prioritizing critical financial needs. It's the first time the company has suspended its quarterly dividend since, get this, 1933. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below for the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, President Trump is expected to impose tariffs on Mexico and Canada tomorrow. Our very own Ines Ferre will break down how these taxes could impact your prices at the pump. And housing listings are becoming stale. Could this mean more leverage for home buyers? That's the big question mark. I talked to a realtor about the state of the housing market coming up. Plus, we're saying goodbye and closing the book on January and saying hello to February and hello to Black History Month. All month long, we'll be speaking with Black leaders in the business world about building their careers, and we're kicking it off with Revolt CEO Datavio Samuels later on in the hour. You do not want to miss it. To kick off our coverage of the day here as well, let's take a look at the market action. 90 minutes into the trading day, we're taking a look at gains across the board, fractional as they may be. The Dow flat, but to the upside. The S&P 500, fractional gains there by 0.8%. The Nasdaq Composite up 1.4%. And this is after what has been a very volatile week. The month, of course, coming to a close following big tech earnings, fresh inflation data. That was in line with estimates. Joining me now, we've got David Wagner, who is the Aptus Capital Advisors Portfolio Manager. David, good to have you back on the program. You say investors need to own stocks for the long haul. What type of long haul are we talking about, and why is that the strategy to keep in mind here?
Yeah, Brad, thanks. I love talking to you here, and I think that's just a great question for the start of the year that we had. I mean, the market's up 4% just in January itself, but you're right, Brad. I love stocks for the long haul. I do understand that there probably could be some volatility this year with everything going on in Washington, D.C., regarding taxes and tariffs, but there's some optimism coming out of DC too with deregulation. But at the end of the day, I think that investors have a lot of trouble actually looking at stocks over the next 10 years just because they think the valuation is expensive right now. Yeah, it's traded at 22 times, one of the highest that you've ever seen on an absolute basis. But investors have troubles looking at the forest through the trees. I mean, the S&P 500, yeah, the top 10 stocks account for 39% of the index, but those top 10 stocks are the reason why I have optimism moving forward in the future, because they bring a newfound characteristic of operating leverage to the benchmark. Large caps are the only major asset class that have operating leverage as a core tenet, as a characteristic. Like small caps are more service-oriented, international service-oriented, and international is more commodity-based. But when operating leverage is working for you, it's your absolute best friend. That's why you can have 5% revenue growth for the S&P 500 this year. That equates to 15% earnings growth. That's how you get margin expansion. And that's one of the best factors that can presage future returns for the market as a whole, is that growth and margin expansion. And right now, it doesn't look to be slowing down. So I would utilize operating margin as your best friend right now. So I'd continue to own large caps.
And so, David, how do you kind of think about the broader push that we've heard from some strategists, or at least them throwing small caps back into the conversation? Because that was the case at the start of last year too, and the broadening was really one of the elements of that push.
Yeah, it's really hard for me to say that I love large caps moving forward in the future. I mean, Brad, I've been a small cap portfolio manager over the last 13 years. I run a small cap strategy that has $500 million. So I love small caps. Don't get me wrong. So it's kind of the bane of my existence to say that I think that operating leverage is going to continue to drive small caps moving forward. But I do think, Brad, we did learn something pretty interesting on Monday when it came to DeepSeek. Obviously, a lot of the power up names of America sold off. You had your Nvidia, your Broadcom sell off in the semiconductor chip space, but still 70% of the market was up on Monday. And I think as the market tries to digest this transition of performance at any cost into optimization, I think that could be another arrow in the quiver for the thesis to actually own small caps, because we all know valuation is very cheap there. You know, small caps historically trade at a 4% premium to large caps, and they're trading at a 30% discount. I think the market's really just looking for another catalyst to have that mean reversion occur. I don't think it's going to go back to historical standards, but between, this optimization of AI, and I think if you have a pullback in rates, I think you could kind of have this broadening trade work out for you.
David, while we have you here, I want to talk about two of your picks. One of them is up over the start of this year, so a good January thus far for Amazon, and then another one that we're tracking in UNH, United Health. So break those two down for us.
Yeah, I think that they're kind of playing on two different thematics here. Obviously, Amazon has been kind of the darlings of trades over the last 6 months, and it actually epitomizes my thesis on large caps as a whole, because one of its main characteristics is operating leverage. And then you look at UNH, and UNH had a very, very difficult fourth quarter, an okay start to this year. They had a tough earnings with a lot of non-recurring stuff on their medical loss ratio. There's still a lot of questions out there, but the valuation is almost just too cheap to ignore right now for UNH. I mean, it historically trades in parity or at a 5% premium to the S&P 500. It's trading closer to a 15 to 20% discount right now. I mean, those are almost at the levels of a valuation discount to the S&P 500 that you saw during Obamacare and a lot of during periods of unknown policy moving forward in the future. I just think that you're at peak policy uncertainty when it comes to UNH right now, and the valuation is showing that. Growth may slow down a little bit in the future than what investors are accustomed to, but you just can't ignore valuation right now for UNH. But at the end of the day, I think operating leverage is the word of the year for me, and Amazon definitely embraces that, whether you're looking at the AWS side, which continues to take market share. We learned that on Wednesday with Azure's number out of Microsoft, but then you also have operating leverage on its consumer side of the business, the retail side. I mean, the stock just does so well when it's harvesting instead of investing. And for the first time in a long time, I see Amazon harvesting right now. So I like both those stock picks moving forward.
David, thanks so much for taking the time here with us.
Thanks, Brad.
Good to see you. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host, Shauna Smith. First up, EA Sports. Is it in the game or not, Shauna? That's the question. They got an upgrade to buy from MoffettNathanson. Analysts there are saying that the recent downward move on shares could be a buying opportunity, citing the video games and the company's strong franchises, including EA Sports FC and Battlefield. Shares up right now by about 3.3%.
Yeah, exactly. I think the silver lining here, or what they're calling the silver lining, is the ability here to further monetize some of those hit games. And you talk about the fact that this is a company that has been looking to streamline its business just a bit. They're saying that they see a lot of the issues that EA has faced here over the last several quarters as, quote, fixable. They have this renewed focus on efficiency that's making it a more attractive investment opportunity. They raised their price target, like you just said, to 145 from 139. We are seeing a bit of a move to the upside here this morning. And again, when you take into account the fact that we're just trading above 122, MoffettNathanson making the argument that it still has a ways to go. They also mentioned the fact that their new FC Rush mode might have been a little bit too popular, might have pulled too much of the attention away from the Ultimate Team, but they are noting that the opportunities to further monetize that game could be an upside push here for EA.
Look, EA Sports FC. I don't know what I think about it just yet. I knew we knew this was coming because of the licensing. Well, no, just I haven't played the game for a while here, but this thing has been named FIFA since I was in elementary school. So I don't know.
Rebranding.
Same game, just new name. All right. Anyway, let's take a look at shares of Vertex Pharmaceuticals moving to the upside after getting FDA approval for its non-opioid painkiller to treat moderate to severe acute pain. It's the first approval in decades for a new category of painkiller. Shares there are up more than 6% during today's activity.
Yeah, certainly they are. And we talked to Evan Seigerman in the 9 a.m. hour about this from BMO Capital Markets, and he was very encouraged by this approval, saying, one, yes, it was largely expected by the street, but he called it a milestone, a game changer here, just in terms of ultimately what this could do to treat pain, this non-opioid option at this point. He also brought up the paying aspect, and I thought this was very interesting. He said that there had been some questions around whether or not payers are going to be paying for this. He said in his view, he said, quote, emphatically, yes, I don't see a situation where a PBM or an insurance company can say, oh, you need to try the opioid option first before this non-opioid version. So he's very optimistic, saying that this could be a further catalyst here to the company, but again, largely expected. And I think we're seeing that reflected a little bit today.
All right, Shauna, thanks so much for breaking these down with us. Appreciate it. We're also tracking utility stocks here today. Utility stocks are on a wild ride. Investors seeing a shift to volatility in a sector that is usually favored for its stability. Yahoo Finance's Julie Hyman is here with us with a closer look at utilities. Hey, Julie.
Yeah, this is a group that I've been watching very closely over the past year, but so has the market. And that's because the thinking is that increasing demand for AI, data centers, is going to be a boon for this industry. Now, let me just set it up here. First of all, you see a lot of green on your screen. This is the one-year returns for this industry. When we talk about utility companies, typically we're talking about two things, sometimes within the same company. In fact, frequently within the same company. We're talking about regulated utilities Those are the companies from which you buy your power. The rates are set by state regulatory commissions. They don't change a lot. And so increasing demand at the margins can be better news for those companies. Then there are power generators. They're generating the power through a number of different means. Traditionally, it was coal. It has really shifted to natural gas. But then, of course, you also have solar and wind, and now on the horizon, perhaps more nuclear power. So that's what we're talking about when we talk about utilities. And if you look at how these stocks have done over the past year, it's not really how utilities typically trade. Vistra has been the big winner, up 300%. It actually bested Nvidia in 2024 in terms of stock performance. And then Constellation Energy has been a big winner as well. Remember, it signed that deal with Microsoft to restart one of the reactors at 3 Mile Island. And Microsoft is going to be paying above market rates for that electricity. It is the first and only deal of its kind signed thus far, but the hopes for more is one of the things that has really lifted the industry. We talked to Anthony Crowdell, who is one analyst who has covered the industry for a long time, and he talked about maybe some of the risks in getting so enthusiastic here.
We're neutral rated on Constellation, which I think was the #2 performing stock in the S&P 500 last year. And we just struggled with valuation. Nothing about the business model, good management team. For us, it was just what people were willing to pay for an IPP story. But it didn't matter. Just this is what happens, I think, when I covered this cycle back in 2003, 2004. And this is what happens when tourists invade a value space. And they just push these stocks up to huge valuations.
When tourists invade a value space, in other words, people who aren't intimately, familiar with the business models of these companies come in because of this big AI thesis. What is all of this predicated on? I want to show you some forecasts for what we're going to see in terms of electricity demand going forward. This coming to us via a company called Grid Strategies, who used data from the Federal Energy Regulatory Commission. And they said back in 2022, the forecast was for load demand, a measure of demand for electricity, would be about 23 gigawatts. But then in 2023, they had to ratchet up their forecast. Then in 2024, they ratcheted up their forecast again, but then they did an addendum that brought it all the way up to here. Now, some of that definitely is because of data centers. In fact, the Department of Energy said last year, data centers accounted for 4.4% of electricity in 2023. By 2028, they should account for 6.7 to 12%. Now, that doesn't sound like a huge jump, but for an industry that doesn't tend to see big increases, it is a pretty significant jump. The question is, how much of that is priced into the stocks, and what are we going to see going forward? Also, are we going to see more deals like the one Microsoft signed with Constellation Energy? Brad?
Julie, excellent breakdown there. A lot to continue to track with utilities here. Appreciate it. President Donald Trump is expected to impose tariffs on the U.S.'s biggest trade partners, Canada and Mexico, tomorrow, February 1st. Now, one area that these taxes could impact our everyday lives is gas prices. Here with more, we've got our very own Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and so this is a very fluid situation because anybody that's following the energy markets is really on the edge of their seats to see if oil would be exempt. And President Trump has said that he is going to decide whether or not to exclude oil from those tariffs. But just taking a look at what analysts are saying and how this would impact gasoline prices, you've got Goldman Sachs that is saying that tariffs, if they were to be imposed on importation of oil, then you would see gasoline prices going up. And you would see the consumer taking the brunt of these tariffs in the short term. So let me back up for a second, because some people may not know that the U.S. imports oil, imports 4 million barrels a day from Canada, imports also 500,000 barrels a day from Mexico. And this tends to be heavy crude oil that is used in the refineries because they use a mix of heavy and also light crude that's here in the U.S. But the Midwestern refineries, those would be impacted. The Rocky Mountains, the Great Lakes. So that is an area where potentially you could see higher gasoline prices if you do indeed have tariffs on importation of oil. And the estimates vary. You've had some analysts estimating maybe between 40 and 70 cents a gallon, a price hike on gasoline. You also have the seasonal prices that are going to be coming into action. That's higher seasonal prices for gasoline going into the summer, which is because of the blend. So you would see a bump because of that as well. So a lot is riding on whether or not you are going to indeed have these tariffs on the importation of oil.
Drill, baby, drill is what we heard along the campaign trail. Deregulation as well. How would that impact prices at the pump? And oh yeah, we just came off of earnings where we heard from Exxon and Chevron where their fuel margins have decreased.
Yeah, that's right. So you do have JP Morgan that has actually analyzed this situation with if you deregulate and have all these permits, drilling permits that are faster, this will lower the cost. And in fact, what they are saying is that the break-even cost for oil in the U.S. is going to be going from $55 per barrel to $45 per barrel. So that'll be cost savings on the company side to drill. As far as Chevron and ExxonMobil, which reported their quarterly results today, one interesting point is that their fuel margins really got hammered last quarter. You saw a 67% plunge in refining profits for ExxonMobil. Chevron's was sank by 72%. So a lot of input of oil, stagnating demand, that has impacted these fuel margins, and tariffs would increase that pressure on those fuel margins, because if you increase the cost of your input for these for importation of oil, then of course that is going to also impact these companies. Chevron refineries, by the way, they noted during their earnings call that they're along the coast, so they would be able to get their oil from different places abroad through ships, wouldn't have to go through pipes coming in from Canada. So they may not feel the impact as much. But one point I will leave you with is that Valero, this is an independent U.S. refiner, they reported their earnings this week. They were asked about the situation of tariffs. When pressed on it, they said that if they do go through, then they would see their throughput decrease by 10%.
Really fascinating. We're going to continue to monitor the situation over the weekend. We know you will be as well. Inez, thanks so much.
Thank you.
Coming up next, ever wonder how the federal government actually affects your day-to-day life? Well, guess what? We're going to break it down for you. Plus, we've got ways to invest in the AI trade beyond just Nvidia. That's next on Wealth. $2,623. That's the number of federal programs targeted by the Trump administration in a memo that sparked confusion earlier this week. The Office of Management and Budget has since rescinded the memo, and the order has been temporarily blocked by a federal judge. But it was a good reminder of just how many different programs the federal government funds and how they might impact you. Joining me now is Yahoo Finance senior columnist Jenna Herron. Jenna, what are some of the most common programs that were temporarily affected?
Yeah, so I think the ones that got the biggest headlines were programs that typically help Americans with a lot of their most basic needs, like insurance, childcare, housing, jobs. There was Medicaid health insurance, which has more than 79 million enrollees. Reports on Tuesday said that the payment portals for Medicaid were down in all 50 states for most of the day. There were also some reports that Head Start payment systems also went dark. Head Start is a reimbursement program that gives low-income families money for their children's early education and childcare. HUD's payment system for grants like Section 8 housing and rental assistance was locked up in some areas. And Pennsylvania Governor Josh Shapiro said that CareerLink, the state's job matching system, was down during that time. So those are some of the big ones.
So there are also some other areas that people might not know rely on government funding. What have you been able to find there?
So when I was scrolling through that huge list of different programs and the descriptions of each, I was thinking to myself, wow, the federal government does all kinds of things. For example, there are loans for farm storage, grants to ensure safe drinking water, funding to implement pool safety laws, money for suicide prevention for veterans, grants for AmeriCorps programs. And really, all Americans benefit one way or another: farmers, native tribes, seniors, people with disabilities, folks living in rural areas, children, veterans. And in fact, if you look at it from a state perspective, more than a third of state revenue comes from the federal government. And that share is actually higher on average in states that supported Donald Trump. That's a huge chunk of spending states depend on. One good example that I ran across in that list, there's a grant to Florida to reimburse citrus producers for the costs associated with recovering from the 2017 hurricane season, which was really, really bad down there. And then even Senator Lisa Murkowski said people in her state of Alaska were worried about a host of different projects, like a dam project, a hydro project, everything from housing to water infrastructure. So I think, Brad, the big takeaway here is that the government really does interact with the people in a million different ways. And if everything is working as it should be, we don't really hear about it. We don't really notice it. It's just the background humming along, and that's the way it should be. It's only when things go wrong or there's a threat that things will stop, like what happened on Tuesday, that maybe we begin to recognize the federal government's positive role in our everyday lives.
Jana, thanks so much for looking into this deeper. We appreciate it.
Thank you.
The tech-heavy Nasdaq has clawed back nearly all of the ground that it lost in Monday's DeepSeek-fueled sell-off. A Chinese startup's cheap AI model rattled big tech stocks and raised plenty of questions about AI investing. Here to discuss, we've got Sylvia Jablonski, who is the Defiance ETF CEO and CIO. Sylvia, great to have you back here with us on Yahoo Finance. We've got results from Apple, Meta, and Microsoft that came out this week. So which of the names that have their own investments within artificial intelligence is best positioned in the AI space from what you've been able to comb through?
Good morning, and thanks so much for having me here. Yeah, the DeepSeek news was pretty interesting for the markets, right? We had this massive amount of momentum for AI, and it kind of halted us. But I think, what's good about this is now investors are really digging in and seeing, where they should get exposure to really get access to that opportunity in a good way. So of the three, the earnings season per se hasn't really swayed me in one way or another in terms of who will benefit most from AI. I think they'll all benefit in some way from AI. I think, Microsoft in my mind is just like the furthest along because of the ChatGPT relationship, the billions of dollars of R&D and spend that, are involved in that, how that's going to turn and foster growth with AI models and all of their AI applications within within their house, whether it's things like Copilot or office tools or data center clouds, things like that. So I just think that they're well positioned. They're already here. They had the ChatGPT moment. You can kind of say that they're almost like the godfathers of AI after Nvidia, that is. And then, with Meta, I think that they have a lot of great information that we're hearing about, and they're going to be able to utilize AI in a good way. But, until it really, really monetizes, I think for now, it's just great technology that's going to come to fruition, and in particular will help them generate more and more ad dollars as it's refined. And with Apple, Apple for me is still more like user X, and yes, that business intelligence is there. We heard a lot about the growth of services and how countries that had phones with the business intelligence, the software intelligence in them had better results than some of the products that weren't updated. So that's a good sign. But I still think that they're coming along.
So beyond the Mag 7, what are the stocks that you like against today's AI backdrop?
Yeah. So, against today's AI backdrop, I love buying on dips. When I see Nvidia fall like this, and for a company that just has this market and its commercial position, its dependability and history with this, I'm definitely buying that stock on the dip. It's something I would look at. But in terms of AI, I'm kind of broadening out to quantum next, right? So I think you need computers that can process this data, supercomputing, parallel computations, things like this, in order for AI to fully work and come to fruition. And so those stocks really took off at the end of the year last year, like the IonQs, the Rigettis, the D-Waves. We've seen $1 billion plus pour into our own quantum ETF, which is like AI, machine learning, and quantum. And so I think that they're going to be, the new kids on the block. And even with Jensen Huang's comments about how long it's going to take, I think, things move faster in tech, and those are good opportunities.
Those of our viewers who closely watch Yahoo Finance trending tickers page, they're probably familiar with some of those quantum stocks as the AI derivative play. And you mentioned Nvidia CEO Jensen Huang kind of downplaying the near-term reality of the tech, saying it could be decades before they're operating at a commercial level. I do want to come back, though, to some of the other AI giants that you've been focused in on, and three stocks that you like amid these headlines, who are also garnering some of their own partnerships. Oracle being one of them. You had mentioned SoFi as well, and then XMAG. Just break those down for us real quick.
Yeah, sure. So SoFi for me, it's another tech company, right? I think what they do is they have this great landscape where they capture young users who need college loans, things like this, student loans, and then they kind of get into their careers. They want to trade crypto and stocks, and they stay with SoFi, and they kind of broaden their experience. So they have great users, great user growth, and I think that the company's just been profitable for the last few quarters. It's just a great tech fin play, in my opinion. Oracle, I think Oracle is like one of those companies that people forgot about for a long time, and here they are taking a lead, whether it's in Stargate, AI data centers, focus on R&D for quantum computing, things like this. I think that they're just really positioning themselves well to have a competitive edge in the AI landscape. And it's, again, one of the stocks that was a little more forgotten after Nvidia. And Oracle and IBM are actually leaders in supercomputing and AI. And so that's interesting. And XMAG is just broaden out from this stuff, right? So do all of that, get your AI exposure, but broaden out to the 493 stocks that make up the S&P 500 minus the Mag 7, in case you get days like DeepSeek just crushing the market. You get some performance from exposure to companies like Eli Lilly, Vistra, Palantir that are not in those top 7. So that's just like a S&P 500 diversifier.
Sylvia, thanks so much for taking the time here with us today. Really appreciate it.
Thank you. Great to talk to you. Thanks.
Coming up, I talked to a realtor about how buyers and sellers are navigating the staleness of the housing market, plus tax season tips. We break down itemized deductions and tax credits next on Wealth. 2 hours into today's trading session, let's take a look at the major averages as of right now. You've seen the S&P 500 in positive territory throughout today's session here. It's up by about 0.7% in the green. The Nasdaq Composite, you're seeing that higher as well here throughout the trading session. That's been up, and right now it's up by about 1.25%. So 1.3%, we'll round that off too. However, this is where we get into some hyper oscillation, some hyper waffling territory, where you've got the Dow Jones Industrial Average, the DJ. IA. Of course, that's been kind of oscillating in and out of gains and losses here on the day. Let's take a look at some of the components within the Dow Jones Industrial Average here. 30 components. We got them pulled up for you here on the screen. I'll just toggle over to it real quick so we can give you that short look here. And there we go. And taking a look at, let's hit that one. There we go. Dow Jones Industrial Average, that's a 1-year look. Intraday here, here's some of the activity that we're tracking. You've got some of those mega cap tech stocks, Nvidia, Amazon, Apple, Microsoft, all in positive territory, being led on a percentage basis by Amazon right now by about 2% here. However, you do have some red, the deepest, the lake red, the maroon red, if you will, Chevron, CVX, that's down by about 3.8%. We'll round that off to here on the day. So that's a quick look at some of those Dow names here. Switching gears, home listings across the U.S. are getting stale. It now takes the average home nearly 2 months to sell. That is the slowest pace since pre-pandemic, according to Redfin. So, what does this mean for the power balance between buyers and sellers in the housing market? For more on this, we have Melanie Atkinson. She's a realtor at Compass. Melanie, great to have you here on the program with us. I mean, if we're pointing back to pre-pandemic times, that just sounds like some normalization perhaps in the mix. What do you think is at play here?
Well, I think that's a really important thing to remember is when we're comparing any housing numbers to the pandemic era, those numbers were really skewed during that time. There was a lot going on. So I like to compare the data to pre-pandemic times. So 60 days on the market is not really that abnormal. It's just abnormal when you compare it to what was happening in 2021 and 2022.
So how can sellers get their homes off the market, knowing that we're going back into this period of normalization and the staleness is hitting some of those pre-pandemic markers?
Well, you just have to go back to the basics of selling. So you have to prep your house perfectly. You have to make sure you have great marketing, and you have to make sure that you're pricing it at market value or maybe just a little bit over. You also have to set your expectations realistically and understand that you're not going to have 15 offers after your first weekend on the market, which is what was happening back during the pandemic era. So now, if sellers do all those things and their house looks great, it will stand out to buyers. There are still buyers buying. They just have a lot more choices now.
And so with that in mind, how can buyers, for their rights, take advantage of some of the deals that they might be looking for or searching for and finding?
Yeah, that's a great question. There is a lot of opportunity out there for buyers now, but I will preface all of that by saying buyers also have to be realistic in the fact that if they think that they're just going to go in and offer on a house that's new on the market and go 20% under and think, well, it's more of a buyer's market now, I should be able to get a great deal. That's not necessarily when they're going to get a good deal. You have to be patient as a buyer if you want the best deal. You need to look at houses that have maybe been on the market for over 60 days that are stale. Those sellers tend to be a little bit more motivated. They have been told by the market that their house is overpriced. And then also be flexible and make sure that you are willing to, maybe go outside of the location that you were previously looking in, or get a house with some questionable cosmetic fixtures in it and be willing to change those. Those are where the deals are happening. And that's what's really interesting about the market now is it's not across the board deals are happening. It's really in the houses that have been lingering on the market for a little bit longer.
Melanie, I wonder what you're seeing in pricing strategy right now, especially as a lot of potential buyers and sellers out there are monitoring the data that's coming through. $404,000 is the average the median existing home price sales as recent of December of last year. And that is the 18th consecutive month of year-over-year price increases, the biggest year-over-year growth that we had seen since October of 2022. What do you make of the pricing dynamic right now, and what are some tips that people can keep in mind?
Yeah, it's absolutely crazy because people see all this inventory going up, but then prices are still going up at the same time. It's really hard for people to understand it. But what we're seeing really is that there are still a lot of buyers out there that have the money to buy houses, and they are still buying. And so we haven't really seen a huge decrease in prices because people are still buying expensive houses. So in general, it's frustrating for buyers because they're waiting for something to happen. But across the board, we're not seeing a lack of demand everywhere. So prices haven't had to adjust that much. You also have, the prices that are going down the most are the houses that people just don't want because they have obvious objections to them. We still have a lot of people moving into the southern area of the country and migrating into that area because it is still a little bit more affordable than the areas that in the north and the west.
All right, Melanie, thanks so much for taking the time here. A lot of tips for anybody who's going out there, gassing up the car, or in my case, just hopping on a bike and going to see some of these open houses. Appreciate it.
Thank you.
Tax season is here, and with it, the question to itemize your deduction or to stick with the standard. Here to help explain which strategy may make the most sense for you, we've got our personal finance editor, Molly Moorhead. Molly, great to have you here in studio with us. So first, what is the standard deduction?
So a deduction is what allows you to reduce your taxable income. The standard deduction is a fixed amount of money, and every taxpayer qualifies for it. If you are single, the standard deduction is just over $14,000. If you're married, filing with your spouse, it's just over $29,000.
Interesting. And so what's an itemized deduction, and what are some of the common itemized deductions that come through in filings?
Itemized deductions are what you can take instead of the standard deduction, and you're essentially choosing from a menu of deductions that apply to your personal financial situation. And the key to all of this is to pick the one that's bigger. And for most of us, it's going to be the standard deduction because it's so much money. The people who might itemize are if you're paying a lot of interest on a mortgage. So, if you bought a house in the last couple of years at a high interest rate, that, the mortgage interest is high right now. If you had a lot of medical expenses in the last year, and charitable giving is another thing you can deduct. And so if those things apply to you and you add them up and they're more than the standard deduction, then you're going to itemize. But again, for most people, most married couples don't have more itemized deductions than $29,000.
Oh, interesting. Okay, so everyone likes saving money, especially on your tax bill. Tax credits can help you do so as well. Could you explain how credits are different from deductions?
Yeah, so as we just said, a deduction lowers your taxable income. A credit comes directly off your tax bill. And so, if you do the process we just described, you crunch the numbers, find out your tax bill is, $7,000. Then you go look at what credits you can take, and they come right off that bill. And so the big common ones are the child tax credits. If you have a child in your care, you get a credit based on your income. And another one is child care credit, and also based on your income. And so that is at the end of the process, and it's dollar for dollar off your tax bill. So deductions and credits are different, but they are both your friend.
Molly, thanks so much for breaking these down for us.
Sure.
Coming up, everyone, Black History Month begins tomorrow. We're talking to the CEO of Revolt about running a Black and worker-owned media network. That's coming up. Black History Month was first federally recognized 49 years ago in 1976, but February has been a time to honor and celebrate the contributions of Black Americans for nearly a century. The first week-long celebration was created in 1926 by the Association for the Study of African American Life and History, led by historian Dr. Carter G. Woodson. All month long, we'll be speaking with Black leaders in the business world about building their careers. And to kick off our coverage, we've got Detavio Samuels, who is the CEO of Revolt, joining me here in studios. Great to have you here.
It's fantastic to be here. Happy Friday.
Happy Friday, and a really happy Black History Month as well here. You know, just as we think about this critical point here that we are at in advancing media, I mean, we've seen so many changes over the past few weeks alone to start off the year. How has the business been doing for Revolt? What are you eyeing for this year and setting as kind of the roadmap for your team?
Yeah, super excited about 2025. For us, 2025 is all going to be about ushering in the next chapter of Revolt. This will be the first year where we're operating as fully 100% or an employee-owned company, right? Our employee group is the largest shareholder base that we have, and so the team is playing and moving like we got a chip on our shoulder, because we do. We got something to prove, you know? And so when we think about this year, I think about it in kind of three things. It's going to be about expanding territory, so you'll see us breaking into new genres and categories you haven't seen. Sports, we just spent the week announcing the launch of our sports vertical with Brandon Marshall and his platform, I Am Athlete. You'll see us getting into gaming. You'll see us getting into food, premium content in a new way. And then it's also just about the next voices. So much of Revolt has always been fueled by creators. So you can't break into these spaces. You can't break into sports without a Brandon Marshall, right? So you'll see us signing new, provocative creators that we think have a voice that is critical for this moment. And then last but not least, what we know about youth culture and our audience is that there's a lot going on in this world, and there's a lot of conversations that need to be had. And so the culture will need a space to identify solutions, organize, have the tough conversations, and we plan on providing that space for our audience and for the culture.
You know, it's so critical that you mentioned that too. I was reading, and of course it pops up in my feed from time to time, just the recognition that so many creators of color have, and that this space, without our voices, does not have the same amount of culture that it would otherwise. Here, how do you kind of, as a media network, lean into that power?
Absolutely. Yeah, without question, what we know is that culture shapes business, right? And so for us to be positioned as the premier #1 youth culture media brand, this is like our space and our time to win. And it's not only our time to win from a performance standpoint, meaning the hold we have on the culture, the ability we have to connect brands and advertisers to that culture in such a very unique and interesting way, but so not only do we have an opportunity to drive business growth for us, not only do we have an incredible opportunity to drive business growth for our brands and our advertising partners, but we have an incredible opportunity to shift culture and shift the world in the ways that we're intrigued about. And so I think we're rooted in the right place, the culture and youth culture. I think we will have an incredible, impactful year.
You know, it's been an interesting and kind of like face in front of fire foes start to the year here. President Trump has made dismantling diversity, equity, and inclusion a cornerstone of his second administration. We've seen major companies, including Target, Meta, McDonald's, and Walmart, they've rolled back their diversity efforts. There have been some that have stood by it on the other side as well. So how are you as a chief executive navigating this?
Yeah, I think it's really interesting times. I think what I want people to understand is the book has not been written, the story has not been written. This is definitely a new chapter, but we're just on the first paragraph. The way that I see it is being anti-DEI is anti-American, right? I think that the framework of DEI is embedded and hardwired and coded into our mission. You think about things like e pluribus unum, right? It's on every single piece of money that we have, right? Out of many is one. That by definition, that's diversity and inclusion. If you think about all men are created equal, by definition, it's about fairness and equity, right? And the same way that I think that DEI is as American as apple pie, I think that being anti-DEI is also anti-business, right? So you start to look at America and you say, where's all the growth coming from? Since the 2010 census, what we've known is that non-Hispanic white population is shrinking, and all of the growth is coming from people of color, right? So any smart businessman, any great advertiser or brand will want to know that if you're gonna grow, you have to bet on the audiences that are growing. And it's not just in the US, it's globally, right? Our white brothers and sisters globally are probably 10, maybe 15 15% of the population. And so if you want to go for the largest audience across the globe, you have to be focused on people of color, right? And so I think diversity, equity, and inclusion is not just good for this country, it's good for business. And so for me, what I want people to know in the way that I think about it is the moment has not been defined. This is the defining moment. And there are no sidelines. Everybody has to choose where they stand. But every CEO, every politician, every college student, every doctor, every human in America has a chance right now to decide how we want this chapter to be written. And I encourage people to make their stance. You'll see us doing that here at Revolt.
Just lastly, while we have you, we got 30 seconds here. What would your piece of advice be to the next generation of aspiring executives who come from multicultural backgrounds?
That you have the juice, you have the sauce. Like if you come from a multicultural background, you know what it's like to have to be resilient. You know what it's like to have to make $1 out of 15 cents. We are primed and posed for this moment, and a moment where costs are needed to be taken out of the business, and a moment where people need to find new ways and new lanes to grow. And again, you know the culture, and you know the culture drives business. This is your moment. Know that you have everything that you need inside of you to perform.
Tavio, great to have you here with us in studio. I appreciate the time.
Thank you, man. Thank you for having me.
CEO joining us here on Yahoo Finance. Everyone, coming up, are you Gen AI curious? Friend of the show, Ross Mack, is going to share the tools that he uses for content creation and investing. That's next on Well. A programming note on this week's episode of Warrior Money, our hosts talk to the founder and executive director of Life Skills for Soldiers, and he shares the story of one soldier that inspired him to start his nonprofit.
Yeah, you know, when I was a platoon leader, I was looking for a way to help my soldiers, and quickly I saw we had money skills, and in particular, we had this one soldier, Private Lopez, who, great soldier, very fit, smart, but a lot of disciplinary issues. He got kicked out of a couple platoons before ending up in mine, and we did a budgeting class, and in that we found out that Private Lopez was not only broke, but it was because he was spending $400 a month on the barracks vending machine. Very preventable issue. And by doing that, getting his NCOs involved, getting me involved, we were able to help him with that, and he quickly became one of our best soldiers. And I think that's just one bullet point where we could do that for thousands, if not millions of our soldiers.
You can catch episodes of Warrior Money every Friday at 12:30 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Generative AI got a lot of attention this week with the sudden popularity of the Chinese bot DeepSeek. So, how are people actually using these generative AI tools? Joining me now, we've got Ross Mack, the host of Financial Freestyle podcast. Ross, I got to know, as a content creator, as an investor, what tips do you have for others who might be generative AI curious these days?
I think first things first, you just got to lean into it, right? You cannot be scared. You have to embrace it, right? As the world continues to change and evolve, you have to do the exact same thing. And when it comes to AI, the goal is say, how do you work smarter, not harder? You lean into it and actually say, what could I use AI for? And I look at it as your own personal assistant, right? Your top executive, right? And I think when it comes to, for instance, social media, I'm gonna use it to better synthesize data. When I post content with my kids in the car, as soon as I get home, I literally just upload the video to Submagic. What does that do? It's gonna write captions for it. It's gonna help do zoom in, special effects, sound effects. That's perfect. When it comes to long form, I'll use Opus. Say I can have an hour-long YouTube video, literally I could just drop it in Opus and it will literally cut down maybe 10 to 20 short form viral clips, right? And another thing I'll do is I'll use ChatGPT. At the end of the day, I will say, okay, what am I gonna talk about this morning? I'll take an article, copy and paste the URL and literally say, I need you to summarize this. And I think the most important thing that you really have to understand is prompting, right? I think the number one class that people are going to start, concentrating in universities will be prompt engineering. And I think when it comes to investing, it's very important that you understand the best way to prompt. And what I mean by that is you're talking to, whether it's DeepSeek or ChatGPT. And when it comes to that, one of the things I'll say is starting off as an investor is, look, hey, ChatGPT, imagine you are a top analyst at Morgan Stanley or at Goldman Sachs, right, on the investment bank. And one of the things I need you to do is I need you to scan and give me the top 5 companies in the cybersecurity space, AI space that fit the following criteria, right? Growing EBITDA over the past 5 years. We're looking at, growing revenue, doesn't have this amount of debt. Right. And I think at the end of the day, you use that to, one, think smarter, because when you are an investor, you got to understand it, right? You're effectively competing with the best in the building, right? Anytime you buy a stock, guess what? BlackRock is also either buying or selling that stock, Fidelity, et cetera. So you ask yourself, how do you compete? Well, guess what? They have a team of dedicated thousands and thousands of, analysts that are looking at these things. And so use AI to actually better equip yourself.
Ross, thanks so much for taking the time here. You can catch more of Ross on Financial Freestyle every Monday, 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton that comes up 3 p.m. Eastern Time. You don't want to miss it.
It's time for Yahoo Finance's Market Minute. Stocks are mostly higher to end a busy week on Wall Street. The Dow teetering while the tech-heavy Nasdaq leads gains. AbbVie shares jumping to their highest level in over 4 years. That's after the drug maker issued an upbeat outlook. AbbVie raising its long-term revenue expectations for 2 new key drugs by $4 billion. In other pharma news, shares of Vertex Pharmaceuticals are higher. It's after the FDA approved its new non-opioid pain treatment. And meanwhile, energy giants Exxon and Chevron are ticking lower after reporting major slumps in their refining profits for 2024. Investors also weighing the potential impact of tariffs on the 2 major oil suppliers. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.